morning friends, welcome to JK Shah classes. This is Professor Saurabh Bhatt. Today we are here to discuss the amendments which are applicable for direct tax paper 7 final CA. Let's start with the amendments. Now we have broken down the amendments chapter wise. So the first chapter, which is your rates of tax, there is only one amendment over here which has been covered by us during the course of our studies, that is with regard to the rate of tax applicable for a company. As far as company is concerned, during the current year, that is FY 22-23 relevant to AY 23-24, the rate of tax is 25% for a domestic company in case the turnover of previous year 2021 does not exceed 400 crores. I have already covered this during my lectures and I have told you the rationale also why we consider the turnover of FY 2021. So just to give a brief explanation about it, the year for which we are appearing, November 23 guys and May 23 guys, we are appearing for FY 22-23 or AY 23-24. Now the provision says that you please consider the turnover of FY 2021. If the turnover of such domestic company during FY 2021 does not exceed 400 crores, in that case the rate of tax applicable for such company is 25%. In any other case, the rate of tax applicable would be 30%. What would be any other case? Any other case would be where the company is in existence in FY 2021 and the turnover was above 400 crores, or the company was not in existence in FY 2021 itself. So, if you are in existence in FY 2021 and turnover did not exceed 400 crores, then rate of 25% is applicable. Now someone may ask me, although I have explained this earlier, that if we are appearing for FY 22-23, then why is it that the government considers the turnover of FY 2021? I have already explained this, friends. In case the government would have said that consider the turnover of FY 22-23, then just imagine a scenario where during the entire year the company does not know what rate of tax is applicable to it. Because during the year, as the turnover would be achieved, the company may think that it is falling either under 25% or 30%. Up till the point the level of 400 crore is breached, the company itself is not sure as to what rate of tax applies to them. That's the reason why we do not consider FY 22-23. Why not, sir, then FY 21-22? Because please understand, friends, when the government announces the budget, the government presents the budget, as we are aware, on 1st of February. So Finance Bill 2022 was presented on 1st February 2022. As on that date, FY 21-22 also had not come to an end. FY 21-22 there were 2 months which were balanced. As a result, the government was not sure that if we consider the turnover of FY 21-22, how many companies would be benefited by this move of granting a concessional tax rate of 25%. But as far as FY 2021 is concerned, already the year has ended, the return of income would have been filed, the GST returns would have been filed, your annual returns would have been filed. So the turnover of this year is definitely locked, crystallized, cannot be changed. As a result, government says you consider this turnover of FY 2021. If that figure does not exceed 400 crores, then such domestic company is liable to pay tax at the rate of 25%. In any other case, as I told you, it is 30%. However, please understand, friends, with effect from AY 2021, AY 2020-2021, the government has got a new tax regime for domestic companies in the form of section 115BAA and section 115BAB. We are not talking here about 115BAA or 115BAB. there is no rate change at all. The tax rates in that alternate tax regime are same as it were in the preceding year, no amendments at all. This we were talking about the rates as per the Finance Act. As you are aware, for a domestic company, they have to choose either to be in the existing tax regime, that is as per the Finance Act, or they have to opt for the new concessional tax regime, provided they make certain sacrifices that they will not claim certain exemptions, deductions, allowances, etc. We have already covered that. So, this tax rate which I discussed is under the existing tax regime. I hope this amendment was clear to everyone. As far as surcharge is concerned, there is not much amendment in the rates of surcharge, except in the case of AOP, where all members of such AOP are companies. In case you are an AOP, Association of Person, and all your members are companies, in that case, the rate of surcharge which will apply to such AOP shall be 10% if the total income exceeds 50 lakhs but does not exceed 1 crore. And in case the total income exceeds 1 crore, where your companies are members, only companies are members. You know that association of person means there are various persons who are members of such AOP who have come with the common intention of earning income. All members of such AOP, if they are companies, in that case the rate of surcharge if income exceeds 1 crore shall be 15%. So, in case of AOP where only companies are members and the total income is between 50 lakhs and 1 crore, the rate of surcharge is 10%, and if the income exceeds 1 crore, then the rate of surcharge is 15%. For all other rates of surcharge, there is no amendment this year, but at the cost of repetition, I may say that with regard to surcharge for individuals, HUF and AOP, other than AOP which I referred to right now, the maximum rate of surcharge if your total income exceeds 5 crores is 37%. Quickly, if I may recap the rates of surcharge for individual HUF and AOP, then if your total income exceeds 50 lakhs but does not exceed 1 crore, then the rate of surcharge is 10%. On total income up to 50 lakhs, there is no surcharge at all. If your total income exceeds 1 crore but does not exceed 2 crore, then in that case, the rate of surcharge is 15%. In case your total income exceeds 2 crores but does not exceed 5 crores, then the rate of surcharge is 25%. And in case your total income exceeds 5 crores, then the rate of surcharge is 37%. That is the maximum surcharge rate which can apply. However, with regard to income earned under the head capital gain, with regard to income earned under the head capital gain, that is section 111A and section 112A, the maximum surcharge which can apply on such tax is 15%. That is the maximum surcharge which can apply. This year one small amendment, 111A we know is short term capital gain on either equity shares or unit of business trust or equity oriented mutual fund, where STT is paid at the time of transfer. We know that long term capital gain again is with regard to these assets when they are sold via recognized stock exchange. This year one of the amendment is that they have also added section 112 in the list. Section 112 is what? Long term capital gain on any other asset other than which are covered under 112A. So, as far as capital gain under 111A, 112 and 112A is concerned, the maximum surcharge which can apply is 15%. Even if, let us say, your total income is 6.5 crores, let us say, and out of this total income of 6.5 crores, you have got capital gain under section 112 of 1 crore and your balance income is 5.5 crores. then as far as the tax on this 1 crore is concerned, the surcharge which shall apply is 15%, and with regard to balance income, you will compute the tax as per the normal slabs or 115 BAC depending on whatever regime the assessee has chosen, and the maximum surcharge of 37% will apply. So the point is, with regard to capital gains covered under section 111A, 112 and 112A, the maximum surcharge which can apply is 15%. That is also the case with dividend. If the assessee has got income comprising from dividend, then the maximum surcharge which will apply on such tax attributed to dividend shall be restricted to 15%. So with regard to four incomes, the maximum surcharge rate can be 15%. That is income covered under 111A, income covered under section 112, income covered under section 112A, and with regard to dividend income. With regard to these four incomes, the maximum surcharge which can apply is 15%. Here one student asked me a question once, and let me just clarify this. This is idiot proofing my entire argument. That is, let us say, sir, the income is 68 lakhs, out of which total income is 68 lakhs, out of which long term capital gain is 10 lakhs and balance income is 58 lakhs. So then how will surcharge apply? Why not 15% on this? See, I said maximum surcharge is 15%, maximum. So first I need to check as per the table given above, what is the surcharge getting applied on this income. If that surcharge is not exceeding 15%, then there is no problem at all. Because as it is, the assessee says up till 15% I have no problem in paying surcharge. So over here, since your income is above 50 lakhs but does not exceed 1 crore, what is the rate of surcharge? 10%. Then I need not do any bifurcation. On the entire tax, the surcharge which will apply is 10%. The problem only arises when your total income exceeds 2 crores, because then on the normal income the surcharge rate exceeds 15%. In fact, it's 25%. So maximum in such case on the capital gain portion shall be 15%. I hope this amendment is clear. So with regard to surcharge, there were two amendments. One is that now as far as income under section 111A, 112 and 112A is concerned, the maximum rate of surcharge shall be restricted to 15%. And as far as your AOP is concerned, where all members are companies, again the surcharge shall depend on your total income. If the total income exceeds 50 lakhs but does not exceed 1 crore, it is 10%, and in case the total income exceeds 1 crore, in that case it is 15%. As far as the other assessees are concerned, not much amendment, no amendment in fact with regard to the rates of tax. 115 BAD, that is for cooperative societies, we have already covered when we did the chapter. Okay. Further friends, the next amendment is with regard to section 68. If you remember, we have covered this section when we did that entire series 68, 69, 69A, 69B, 69C, 69D. This is nothing but your undisclosed income or income which you have not offered to tax. Because you have not offered to tax and the government finds out about such income, the government says, I will charge tax at a higher rate. So that is at the rate of 60%, 60% under section 115 BBE. So under section 115 BBE, if you are having income earned under section 68 to 69D, tax rate which will apply is 60%. Not just 60% tax, but there would be a surcharge of 25% on the tax, and on the total of tax plus surcharge, there would be a education cess of 4%. In short, your effective tax rate comes to 78%. So that's pretty harsh. But the idea of the government is that you have not disclosed this income. I have come to know about this income. So as a result, I am going to penalize you by charging a higher rate of tax. In that series of section 68 to 69D, the first section, 68, talks about unexplained cash credits. What do you mean by unexplained cash credits? Basically, if you receive any amount during the year, if there is a credit in your books of accounts of any amount, there is a receipt of any sum of money, you are required to explain three things. You are required to explain the identity of the person who has given the amount. You are required to explain his creditworthiness, and you are required to explain the genuineness of the transaction. Let me give you an example. Let us say in my bank account, some distant relative suddenly transfers 1 crore rupees as gift. Maybe gift on the occasion of marriage, or gift on my birthday, or gift on any occasion. That person has transferred 1 crore. Naturally, the tax authority is going to ask me, who is this generous person who has gifted you 1 crore rupees, and where does this person stay? So first and foremost, I am required to establish that person's identity. So I am required to say he is Mr. XYZ, his PAN number is so and so, or Aadhaar number is so and so, his address is so and so. That would establish the identity of the person who has given me the gift. Second, I am required to explain his creditworthiness. Naturally, if that person is giving 1 crore rupees, and let us say his returned income is 2 lakh rupees, uska taxable income is only 2 lakhs, but he has given me a gift of 1 crore, do you think the transaction is genuine or non-genuine? Naturally, it is non-genuine. The question which comes to my mind is, how can a person who is earning only 2 lakh rupees give me a gift worth 1 crore? It's next to impossible. So I have to establish the creditworthiness of that person who has given me the gift. It can be any example. I mean, gift is just one example. It can be anything, loan. It can be even investment in my shares, any receipt. And third is the genuineness. Has it come via banking channels, or is it just a book entry? Has that person deposited cash just one day prior to giving me the gift? All those would establish that the transaction is non-genuine. So it is my responsibility, it is my onus, there is a legal word for this, it is my onus to establish that the transaction is genuine. If I do not do that, then section 68 says that such amount shall be treated as my undisclosed income. If it is treated as undisclosed income, then 60% tax rate will apply under section 115BB. Now the amendment over here is a bit draconian. The amendment is that many people would try to get away with this section 68 by doing a circuitous transaction. What do you mean by circuitous transaction? Let us say I have received a loan of 1 crore rupees from X Limited. Now the assessing officer asked me that please establish this X Limited is capable of giving this 1 crore rupees. Now I write to X Limited replies that they have received internal loan from Y Limited. Now I tell the AOC this is sufficient explanation. X Limited has given me the loan. What is the source of money which he has given me? The loan which he received from Y Limited. Now the AO says, I don't believe this to be a genuine transaction. But the AO cannot do anything. Because with regard to the person from whom I have received the amount, I have established the source of that. Once I have established the source of where I am getting the money from, the AO cannot question me beyond that. So what people used to do, instead of converting black money into white and directly taking it into your account, I would have a 3-layer transaction. So I would convert the black money into white by giving it to Mr. X. I would tell Mr. X, you give it to Mr. Y as a loan. Mr. Y will give me as a loan. And when the AO asks me, I would say, okay, Mr. Y has given me the loan. Source is the amount which he received from X. How X received it is none of my business. Because I am required to establish only the identity, creditworthiness, genuineness of the person from whom I have received the amount. So many tribunals were taking a view that in such scenario, no adverse action can be taken on the assessee. In order to overrule that position, the government has amended the provision of section 68. Now you see what the provision says. It says, where the sum so credited, means where you have received any money, consists of a loan or borrowing. So the amendment applies with regard to loan or borrowing or any such amount by whatever name called. Any explanation offered by the assessee in whose books such sum is credited would not be deemed to be satisfactory unless the person in whose name such credit is recorded in the books of such assessee also offers an explanation about nature and source of such sum so credited, and in the opinion of the assessing officer, such explanation has been found to be satisfactory. So please understand friends, with regard to loan or borrowing now, I am not only required to explain the source of my receipt, so I am also required to establish the source of source. Source of source means I received from X. So I am required to establish identity, creditworthiness, genuineness of X. Now X says that this amount was received by him from Y. So now I am required to establish the identity, creditworthiness, genuineness of Y. If I don't do that, if I don't explain the source of source, then this amount shall be treated as my unexplained cash credit and provision of section 115 BBE shall be attracted. I hope this amendment is clear. Let me tell you 2 points over here. This requirement of establishing source of source, that is not only the identity, creditworthiness, genuineness of person from whom you received it, but also the person from whom that person received it. That requirement was there in law with regard to share application money or share capital, share premium since the year 2013 itself. Since 2013, if you received any amount with regard to share application money or share capital or share premium, you are required to explain not only the source but source of source. That amendment was inserted to neutralize the decision of CIT versus Lovely Exports, Supreme Court. In order to neutralize that with regard to share capital, this requirement was already there. Now that requirement is extended. Now not only with regard to share application money or share capital money, but also with regard to your loans and borrowings, you are required to explain the source of source. That is clarification number 1. Second thing I want to clarify, just a related point, that when section 115 BBE is attracted, that is your 78% tax is attracted, then the penalty under section 271 AAC is also attracted. Section 271 AAC says that a penalty of 10% on the tax shall be imposed. So that is 78% tax plus 10% of that will be penalty. So 85 or 86% is gone in tax plus penalty itself, notwithstanding the interest and your other prosecution. आपको जेल में डालेंगे, that is a separate thing, but other than that these tax effects will be attracted. Fair enough. I hope this amendment was also clear. Let me proceed on to the next amendment. This amendment, by the time the amendment has come, the section itself has become useless. I mean, if I may say so, if I may be excused for saying so. Why do I say this section has become a bit useless by the time clarification has come? Friends, in the year 2004, our government declared that dividend received by a shareholder shall not be taxable in the hands of shareholder. Rather, the company which is distributing that dividend shall pay a 15% dividend distribution tax. The manner in which they used to calculate that dividend distribution tax, effective rate used to come to 20%. So let us say 20%. So government said when a company distributes dividend, the shareholder is not required to pay tax on that dividend. It is the company which is distributing the dividend, they shall pay a 20% dividend distribution tax, DDT. So in the hands of shareholder, dividend is exempt from tax. But the problem was that shareholders, let us say a stockbroker or an investor who is having various kinds of income including dividend. So he has got taxable income also, he has got exempt income also, major part being dividend. The expenditure which is debited in his P&L consists of expenses which are incurred for earning taxable income as well as expenditure incurred for earning exempt income. So the question arises, if the income which is exempt is not getting taxed, then the corresponding expenses which are incurred for earning that exempt income should also not be allowed as deduction. Let me explain this with the help of an example. Let us say in my P&L, I have got two incomes. One is taxable income of 100 lakhs and exempt income of 20 lakhs. Correspondingly, for earning the taxable income, I have incurred expenditure of 18 lakhs and for earning exempt income, I have incurred expenses of 2 lakhs. If I talk based on your matching concept, which you have learnt in accounts, how much should be the net taxable income? You will say, sir, 100 minus 18, which is 82. And how much is the net exempt income? You will say 20 minus 2, which is 18. But the problem, friends, is that how do I bifurcate the expenses between those which are incurred towards earning of taxable income and those which are incurred towards earning of exempt income? How do I make that bifurcation? For that purpose, government introduced a rule 8D. They gave a formula. We have done that formula in class. You apply rule 8D in order to arrive at the bifurcation of expenses between those incurred towards earning taxable income and those incurred towards earning exempt income. Whatever is the result of that formula shall be deemed to be expenses incurred towards earning of exempt income, and that much expenses shall be disallowed, as simple as that, because corresponding income is not getting taxed. So that expense which is incurred for earning that income shall also be disallowed, as simple as that. But the problem was that sometimes this formula of rule 8D resulted in a figure of expense which was exceeding the exempt income itself. So let us say my exempt income is 2 lakhs. The formula would sometimes throw up a figure of, let's say, 15 lakhs. The assessee would contest, saying that how can I incur 15 lakhs for earning only income of 2 lakhs? It seems absurd. But the income tax department used to counter argue that when you do business or you have income under any other head, of course except salary, do you not have a loss? Of course you can have a loss. The loss means what? The expenditure is exceeding your revenue. So applying the same rationale, your expenditure incurred for earning exempt income may be exceeding the exempt income itself. The matter reached Supreme Court of India. Supreme Court did not agree with the contentions of Income Tax Department. Supreme Court said that Rule 8D is only an estimation, is only an approximation is only a guesswork with regard to how much expense the assessee may have incurred for earning exempt income. It is not an actual figure. It is not a scientific formula. It is just an estimation. Even the income tax department does not know that how much expense the assessee has incurred for earning exempt income, because many expenses which you incur are common in nature. I'll give you an example. Let us say one common office I am using for two separate activities. One activity is resulting in exempt income, another activity is resulting in taxable income. How do I bifurcate the rent expense? It's not possible. So what Rule 8D does is that it only provides an approximation. So Supreme Court said, sorry income tax department, when you are doing such kind of approximation, that approximation should not be prejudicial to the interest of assessee. As a result, in case of Rule 8D, the expenditure incurred as per Rule 8D, computed as per Rule 8D, cannot exceed the amount of exempt income. It cannot. That is what Supreme Court said in the case of State Bank of Patiala. In order to overrule that decision, government has introduced an explanation. The explanation says, let me read that explanation first. It says expenditure incurred during a previous year in relation to exempt income would be disallowed while computing total income of that previous year by applying the provision of section 14A even though such exempt income has not accrued or arisen or has not been received during the said year. So even if income has not arisen, that is your exempt income is zero, even then Rule 8D can be applied, that is section 14A read with Rule 8D. Or in other words, I can say the expenditure to be disallowed under section 14A can very well exceed the amount of exempt income itself. But why did I start by saying this is a useless kind of amendment? Because with effect from FY 2021, dividend is no longer exempt. Now it is again taxable in the hands of shareholder. So now there are very few exempt incomes, and as such section 14A becomes a bit redundant. But anyway, I hope you understood this amendment. Let's proceed. The next amendment pertains to your salaries chapter. As we all know, in the year 2020 and later in 2021, there was havoc caused on account of COVID and the related ailments, diseases, deaths. As a result, Government of India made certain amendments in provisions relating to perquisites. So as far as medical treatment is concerned, section 17 subsection 2 already provided that if the employer maintains any hospital, the cost of treatment provided to an employee shall be treated as exempt perquisite. It is a benefit arising because the employee has to undergo a treatment, he has to make an expenditure. Because the employer maintains his own hospital, so the employee does not have to spend anything or he has to spend at a concessional rate. So there is a benefit, but that benefit is exempt from tax. Also, in case the employee incurs an expenditure on medical treatment in any hospital maintained by the government or by local authority, or incurs expenditure with regard to your prescribed diseases, then in that case reimbursement of such expense actually incurred by the employer is also exempt from tax. It is also an exempt perquisite. This year the government has added to the list that in case the employer reimburses to the employee the cost incurred towards medical treatment arising on account of illness relating to COVID-19, then if the conditions are fulfilled, such reimbursement shall also be exempt from tax. Now what are the conditions? The conditions are that the employee has to submit the following documents to the employer: COVID-19 positive report of the employee or family member, or medical report if clinically determined to be COVID-19 positive through investigations in a hospital or inpatient facility by treating physician of a person so admitted. Second, all necessary documents of medical diagnosis or treatment of the employee or his family members for COVID-19 or illness related to COVID-19 suffered within 6 months from date of being determined as COVID-19 positive. And last, a certification in respect of all expenditure incurred on COVID-19 or illness related to COVID-19 of the employee or any member of his family. So if the employee submits all these documents to the employer reimburses the cost incurred to the employee, then in that case, the benefit arising to the employee shall be exempt from tax. There will be no taxable perquisite. That's about it as far as salary chapter is concerned. No other amendment as such. Moving ahead to the next one, as far as PGBP chapter is concerned, one small amendment in section 35. We have discussed this in our lectures, but this lecture is dedicated towards amendments, so I am reiterating that. We all know that under section 35, in case any person gives contribution to notified approved research association or university or college or other institution for scientific research, or a notified company for scientific research, or any contribution for social or statistical research to notified approved institutions, then under section 35, 100% of such contribution is allowed as a deduction. Up till AY 1819, there used to be a weighted deduction. You contribute 100, maybe you get 125 or you get 150 rupees as deduction. But government has done away with those weighted deductions. Now 100% is allowed as deduction. Last year, government introduced a measure in order to check, in order to control, in order to plug the unscrupulous elements of society who use such institutions for converting their black money into white. Just in order to claim deduction, they enter into backdated transactions. So now government says that in case you make any such contribution to these institutions are required to file an annual statement comprising list of all those donors who have given contributions during the year. In case such institution does not file the statement or furnishes a statement in which your name does not appear, then you will not be entitled for deduction under section 35. So now, not only that you have to make a contribution, but after you make a contribution, such research association, university, college, etc. have to make a statement in the prescribed format for that period and deliver it to the prescribed tax authority, that is form 10BD, B for Bombay, D for Delhi, or to the person authorized by such authority in such form as may be verified in such time, etc., etc. That is fine. Such association may also deliver to the prescribed authority a correction statement. So if there is any mistake, you can always correct it, that is fine. But in case the donor is not provided with the certificate that is generated after furnishing that form 10BD, the certificate is in form 10BE, B for Bombay, E for Ernakulam. If you don't generate that certificate and give it to the donor, then the donor will not be entitled for deduction of that 100% contribution. So you can please read this. This is the amendment. The next amendment is with regard to section 37. Again, here I'll have to give you a backstory to this amendment. We all know that as per section 37 subsection 1, if any expenditure is incurred by an assessee wholly and exclusively for the purposes of business or profession, then such expenditure is allowed as deduction for the assessee while computing PGBP income. In the year 2001, ITAT Mumbai gave a verdict in the case of Pranav Construction Company. Pranav Construction Company were builders or developers, and they were giving hafta, as you call in Bombaya Bhasha, hafta, that is on money, to various gunda mafia people. So the question arose whether such hafta is allowable as deduction. Pranav Construction Company argued that without giving this hafta on money, it is not possible for them to conduct their business, because the gundas, antisocial elements, will not allow their projects to get completed. ITAT Mumbai allowed the deduction. In order to neutralize that decision, government inserted explanation 1 to section 37 subsection 1. This explanation said that if any expenditure is incurred which is prohibited by law or which is deemed as an offence, then such expenditure is not allowed as a deduction. Now from 2001, let me leapfrog 11 years. In the year 2012, Central Board of Direct Taxes came out with an instruction. If I am not mistaken, it is instruction number 5 of 2012. In that instruction, CBDT referred to a guideline issued by Medical Council of India. And they said, as per Medical Council of India, for doctors it is prohibited, it is debarred from accepting gifts or freebies from pharmaceutical companies. Many a times it happens, friends, it's a dark reality of our society. Pharmaceutical companies go to doctors, lure them with maybe fancy foreign trips, luxury cars, gold watches, or some other kind of benefit. And in return, naturally, the doctor says, whichever patient comes to me, I will prescribe your medicine. So, Medical Council of India in the year 2009 prohibited doctors from accepting such kind of freebies, and if they were caught, their license would be suspended. So, CBDT in the year 2012, relying on the MCI guideline, that is Medical Council of India guideline, stated that for pharmaceutical companies, if they distribute any such kind of freebies to doctors, then that would be deemed as prohibited by law and the expenditure would be disallowed in the hands of pharmaceutical company. Many challenges were made to this particular instruction, and finally again ITAT Mumbai in the case of PHI Pharma held that the freebies and gifts given to doctors by pharmaceutical company, which was wholly and exclusively related to its business, would be an allowable expense, because ITAT Mumbai said that Medical Council of India guideline only applies to doctors. It does not apply to pharma companies. It is prohibited for the doctors to accept gifts, but it is not prohibited for the pharma companies to give such gifts or freebies. That was the rationale given by ITAT Mumbai. Again, in order to neutralize the decision of ITAT Mumbai, government inserted explanation 3 to section 37 subsection 1. What does this explanation say? It says the expression expenditure incurred by an assessee for any purpose which is an offence or which is prohibited by law would include and would be deemed to have always included. This is government's way of saying this is a retrospective amendment. or a clarificatory amendment. When they say it is deemed and always deemed to have been, means the government is trying to tell you that, boss, my understanding was this right from the beginning. Your understanding was wrong, which I am clarifying. That is the meaning of is deemed and always deemed to have been. Deemed to have always included expenditure incurred by an assessee for any purpose which is an offence under any law for timing in force in India or outside India, or which is prohibited by any law for timing in force in India or outside India. Second, or to provide any benefit or perquisite in whatever form to a person, whether or not carrying on business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guideline, as the case may be, for timing in force governing the conduct of such person. So if it is violation of law for the opposite person to accept gifts as per some guideline or regulation, then even for the person who is the donor, that expenditure will be disallowed. That is the amendment made in law in order to neutralize the decision of PHI Pharma. But let me tell you one interesting thing, friends. When this amendment came, it was brought about to neutralize PHI Pharma. But in related cases where the High Court started allowing deduction based on PHI Pharma, they were challenged by Income Tax Department. This I am talking about the pre-amendment era. They were challenged by Income Tax Department to the Supreme Court. And after this amendment has been brought in law, Supreme Court has declared the decision of PHI Pharma itself to be erroneous. Supreme Court said this logic of ITAT Mumbai is not correct. If accepting something is wrong, then facilitating that is also wrong. It is as good as, oh, I gave a bribe to a person, let us say to some government authority, I gave a bribe. Accepting bribe is a crime. Naturally, even facilitating that should be a crime, as simple as that. You cannot look at every rule and regulation in the light of legal language. You have to look at some things based on public policy. So Supreme Court took a larger perspective of the issue. Supreme Court said, why is it that Medical Council of India has given this prohibition on doctors? Because doctors, when they prescribe medicines, they are required to prescribe medicines based on the patient's requirements. They should not prescribe a medicine just because a pharmaceutical company is helping them. That would be against public policy, and you would be playing with the health of thousands and lakhs and crores of people. That's the reason why Medical Council of India issued the guidelines in the first place. So if a pharmaceutical company claims that these guidelines do not apply to me, that stand would be erroneous, because those guidelines have been issued in public interest, and opposing public interest cannot be held to be legal. So friends, although this explanation is there, it has been brought in law in order to overrule PHI Pharma, but now PHI Pharma itself has been overruled by Supreme Court in Apex Laboratories. I am just reading this decision because a very fantastically dictated decision of Supreme Court, one of them is Apex Laboratories. My request to you is, after your exam, especially those who are appearing in May, if you have got the time and inclination, of course, please read this decision. Very nicely worded decision. It says, the Supreme Court in Apex Laboratories held that the incentives or freebies given by pharmaceutical company to doctors had a direct result of exposing the recipients to the odium of sanctions, leading to a ban on their practice of medicine. So it was prohibited for the doctors. Those sanctions are mandated by law, as they are embodied in the Code of Conduct and Ethics, which are normative and have legally binding effect. The conceded participation of the assessee means you are facilitating that by giving these kind of gifts. Pharmaceutical company, that is provider or donor, was plainly prohibited as far as their receipt by medical practitioners was concerned. that medical practitioners were forbidden from accepting such gifts or freebies was no less prohibition on the part of the giver or donor, that is pharmaceutical company. Thus, pharmaceutical company giving freebies to doctors is clearly prohibited by law and not allowed to be claimed as a deduction. Doing so would wholly undermine the public policy. As I told you, Supreme Court looked at the larger picture and said that all this is against public interest, so this cannot be allowed. So the whole conclusion of this is that explanation 3 inserted in section 37 subsection 1 is in consonance with the above Supreme Court judgment. So explanation 3 overruled PHI Pharma, Apex Laboratory also overruled PHI Pharma. So now explanation 3 and Apex Laboratories are at par in consonance with each other. I hope this amendment is also clear to everyone. Let us go ahead with the next amendment. When I introduced the next amendment in classroom, I gave an example which I would like to repeat. That is section 40 clause A subclause 2, since the very beginning, since the time it has been inserted, says that if you pay any tax, that is income tax, then such income tax payment is disallowed. Now many people, predominantly I would say in the case of Cessa Goa Limited, the assessee said, look at the provision, what does it say? Income tax is disallowed. It does not talk about education cess, it does not talk about surcharge. So as a corollary, if income tax is disallowed, that is what is stated in law, then the surcharge and education cess should be allowable as per law. This is what Cessa Goa claimed. I would say that logic itself was erroneous. I did not subscribe to that logic right from beginning. Because the example which I gave to explain this is that suppose a student is eating a sandwich in my class. I tell the student that please do not eat sandwich in my class, I do not like it. Next morning he is eating poha in my class. I tell him, what did I tell you yesterday? Why are you eating? He says, sir, yesterday you told me that sandwich is prohibited in class. I am not eating sandwich, I am eating poha. This should be allowable. Is that logic correct? I would say, although the student is following the letter of law but not its spirit, or he is following the letter of my instruction but not its spirit. The spirit of what I said was, please don't eat in my class. Although in online lectures you all have the convenience of just switching off video and eating. But that aside, the point is, when the income tax department said that tax is disallowable, income tax is an appropriation of your profits. Income tax can never be allowed as an expense. So resultantly, surcharge and education cess also is not allowable. And someone might say, sir, why was the government not so cautious in inserting education cess also, surcharge also? Because please understand friends, education cess in India was inserted in the year 2004. Prior to 2004, there was no education cess. And when it was introduced, it was 2%. Gradually became 3% and now it is 4%. Health and education cess. So when the government introduced this provision, 40 clause A subclause 2, there was no education cess at all. So that argument according to me was fallacious. But anyway, people were arguing on that ground. This year government said, let us clarify on this aspect. They said the term tax would include and would be deemed to have always included any surcharge or cess by whatever name called on such tax. Hence, tax including surcharge and cess would be disallowed while computing business income. Now many students, when they used to come to me before the amendment and ask me this question that, sir, is education cess allowable? I used to tell them, according to me, not. They used to say, no, sir, but there is a Cessa Goa decision. I said, I am perfectly aware of that, but there are contrary decisions also. ITAT Calcutta has given a contrary decision. So they used to then ask me a subsequent question. The question was that, sir, assuming education cess is allowable, then how do you compute the allowable deduction? Because tax is computed after profits are computed. Tax is computed on profits. Now if we say for computing that profit, education cess is allowable, then how do you determine this? Because education cess would be computed after the total income is computed. So if you say that education cess is allowable as deduction for computing total income, I hope you understand what I am trying to say. And my answer used to be, maybe you draw a mathematical equation by taking x and y, something of that sort, because the argument in itself was not convincing to me that education cess is allowable. But any which ways, now the government has clarified education cess is not allowable in nature. Let me also tell you one related amendment. In section 155, the government has amended that provision to state that there must be various assessees who over a period of time have been claiming education cess as allowable expense. Now suddenly when the government has clarified this with retrospective effect, it may lead to reopening of assessments of several years, which may cause a lot of problems to the assessee. Why would the assessment be reopened? To disallow the education cess. So government said that if the assessee before 31st March 2023 suo moto goes to the AO, assessing officer, and makes an application for rectification and says that please disallow this cess in view of the amendment in law, then the assessing authority would pass a rectification order disallowing the cess, notwithstanding that time limit for rectification may have expired. And in such case, because the assessee has voluntarily come forward and disallowed the cess or asked the AO to recompute the income by disallowing the cess, there would not be any penalty proceedings on the assessee. No penalty will be imposed. That is a related amendment. Fair enough. Moving ahead to the next point. Next point is with regard to section 43B. Now here again, in fact, if someone asks me that do you have any grievance with the finance minister, then I would say that one of the grievances, I do not understand why the government is so touchy with regard to every decision which comes against the government. Any decision comes against the government, they are always ready, steady to amend the law in order to take it their way. Let me tell you what happened with regard to section 43B. Friends, as we know, in PGBP chapter, certain expenses are allowed as deduction only if they are actually paid. If you have not actually paid the amount, then no deduction will be allowed to you. Like for example, bonus or any tax or gratuity or leave encashment, all this is given in the list of section 43B. One of the items given over there is interest payable to banks. In case you have to pay interest to any scheduled bank or to cooperative bank or now even to NBFC, that interest will be allowed as deduction only if it is actually paid. If it is not actually paid, no deduction will be allowed. A question arose, sir, what about the interest unpaid which gets converted into a fresh loan? Banks many a times do that restructuring. Suppose I am not able to pay interest on my loan, working capital loan, the bank will say, okay, that interest we will convert it into a fresh loan and provide you maybe 10 installments to pay it. So whether that conversion of unpaid interest into a fresh loan can be regarded as actual payment, here the law is very clear. Explanation 3A clarifies that conversion of unpaid interest into a fresh loan will not be regarded as actual payment. There was a dispute in this relation in the case of Aqua Technologies. It must be mentioned here somewhere, Aqua Technologies. Now what happened in the case of Aqua Technologies, the assessee had to pay some interest to ICICI Bank. The assessee did not have funds to actually pay the interest, rather they issued debentures to ICICI Bank. They issued debentures and they claimed that the interest has been actually paid by way of debentures and therefore they should be allowed deduction for the interest expense. The income tax department said debenture is nothing but debt. So it is as good as conversion of your unpaid interest into a loan or borrowing and therefore deduction is not allowed. Delhi High Court confirmed the view of income tax department. But by the time matter reached Supreme Court reversed the entire decision. Supreme Court said that debenture cannot be equated with any other loan or borrowing. Supreme Court went into the genesis of this amendment. Supreme Court said, why is it that unpaid interest, when it is converted into a loan, it is not allowed as a deduction? Because in case of banks or financial institutions, the law prescribes that when there is a non-performing asset, they can defer the recognition of interest up till the point when they actually receive the interest. So if there is unpaid interest, the government says bank is not going to recognize the interest, so we are not getting tax from the bank. So we will correspondingly not allow deduction to the person who is paying that or who has incurred that interest expense. Because सामने वाला tax नहीं दे रहा है, तो the payer should not get a deduction, or the person who has incurred the interest cost should not get a deduction. That's the genesis. Supreme Court said in this particular case, when the assessee, Aqua Technologies, issued debentures to ICICI Bank, ICICI Bank recorded the receipt of debentures. They passed an entry in their books of accounts recognizing the debentures as asset and correspondingly recognizing the interest income. So when ICICI Bank has recognized the interest income, correspondingly the assessee Aqua should be allowed as deduction. And even otherwise, debenture cannot be regarded as a loan or borrowing. On those two rationales, Supreme Court said where unpaid interest was discharged by issuing debentures, it amounted to actual payment and thereby deduction under 43B is allowable. In fact, friends, before I get on to the amendment, when I was reading this decision, one thing that crossed my mind was that there are such finer nuances in law, which many a times we read law several times, but sometimes these finer nuances we miss out. One sentence was given in that Supreme Court decision which is quite obvious as such, but I was just wondering why did it not strike me when I read this 43B so many times. Supreme Court said that in various provisions, the government has mandated that there must be payment, actual payment, by way of account pay check, account pay draft, ECS or other prescribed modes, that rule 6 ABBA. But as far as 43B is concerned, if you read the entire section 43B, nowhere it is given that actual payment has to be by account pay check, account pay draft, ECS or other modes. It merely says that deduction will be allowed if actual payment is made. So Supreme Court said actual payment can be even in kind. It can be by way of issue of debentures. So on that rationale also Supreme Court held that here deduction will be allowable. Now as you may have guessed it where I am heading, the amendment this year is to neutralize the decision of Aqua Technologies. I'll read out the amendment. It's quite simple for you to understand. It says, explanation 3C, 3CA, 3D clarifies that if any sum payable by the assessee as interest on such loan or borrowing or advance referred in clause D, E or F, that is scheduled banks, cooperative banks, NBFC like that, is converted into a loan or borrowing or advance or debenture or any other instrument by which liability to pay is deferred to a future date. So now not only conversion of unpaid interest into a loan or borrowing, but also conversion into a debenture or any other instrument. Otherwise tomorrow someone may say, okay, I'll issue now preference shares, debenture nahi kar sakte na, I will issue preference share, not allowed. You sort of convert it into debenture or any other instrument by which liability to pay is deferred to a future date. The interest so converted and not actually paid shall not be deemed as actual payment and hence would not be allowed as deduction. The clarificatory explanations only reiterate the rationale that conversion of interest into a loan or borrowing or advance or debenture or any other instrument by which liability to pay is deferred to a future date does not amount to actual payment. So again, this is a clarificatory amendment. So I hope you understand. Government says my understanding was correct right from the beginning. In fact, in the context of amendments made in Income Tax Act, I always say that when children are playing and one of them is losing, they change the goal post. We say it in English that the person changed the goal post. As far as government is concerned, they change the game itself. So they are playing cricket, suddenly they'll start playing hockey. It's like that. Such drastic amendments are brought in law just in order to prove their one simple point. Anyway, I hope this 43B was clear. Moving ahead to the next amendment, now this pertains to capital gain chapter. First one is quite simple. The cost inflationary index is 331 for FY 22-23. We know this because we have solved questions, so we are aware. But let me tell you all one thing, if I may be allowed to sidestep for 30 seconds. When we start teaching at the beginning of the lectures, suppose the CII has not come, so we give a sort of a random figure approximation that CII when it comes we will tell you, and till then let's adopt this figure. So one year, I think FY 21-22, I do not know, I was teaching, the CII figure was not yet prescribed by government, and I told the students that I have called up Nirmala Sitharaman and she has told me the CII will be 317, just a random figure. And later when CBDT actually, it was just a guesswork, and CBDT actually prescribed it as 317 for the entire year. People really thought I had some connections. Let me clarify, no connections, it was just guesswork. For this year, all those my friends who are appearing in May 23 and November 23, the CII is 331 of the current year. Okay, next one in capital gain is with regard to meaning of slump sale. This amendment actually was brought about by Finance Act 2021. We have already covered this amendment in detail. If you remember, while computing slump sale or while introducing the concept of slump sale, I told you that earlier, prior to Finance Act 2021, how people used to evade paying taxes. Let us say I acquire an undertaking by way of slump sale. In discharge of the consideration, I issue certain shares or I give some other asset. Now technically there is an exchange because I got an undertaking and instead of giving money I have given some other asset. So assessees used to argue that there should not be any tax in case of such transactions because the provision permits taxation only of slump sale. Sale means where you have acquired an undertaking and paid the consideration by giving money. If no monetary payment is made, then it is not a slump sale, it is a slump exchange, and there is no provision to tax such slump exchange. Finance Act 21 has clarified this, that now any kind of transfer arising in the context of slump sale, any kind of transfer will be subjected to tax, and for that purpose computation mechanism is also prescribed. We have done several questions on this where we compute FMV1, FMV2, take whichever is higher. FMV1 being the FMV of outgoing assets, FMV2 being the FMV of incoming assets, and whichever is higher shall be considered as FVOC. So now in reality, if you say that this provision, sir, has become taxation of slump transfer, then I would agree with you. So now it is not necessary it has to be sale, it can be slump exchange, it can be any kind of slump transfer. Fine. After that, next amendment is with regard to your computation of capital gain under section 45 subsection 1b. Again, during the course of our lectures we have covered this exhaustively, because this amendment as such was prescribed by Finance Act 2021. So this is technically not a Finance Act 22 amendment, this is a Finance Act 21 amendment. If you remember the concept that on or after 1st February 2021, if an assessee acquires unit linked insurance plan or ULIP in short, and the premium payable annually in respect of such ULIP exceeds 2,50,000 rupees, then the gain arising at the time of maturity or surrender of such policy shall be taxable in the hands of assessee as capital gains. The government has made related amendment in section 112A. So the gain arising on surrender or maturity of such ULIP, that is where the premium exceeds 2,50,000 rupees, shall be taxable at the rate of 10% on the gain exceeding 1 lakh rupees. No benefit of indexation will be allowed on this. Also, please remember friends that a detailed question has been solved on this during the course of our lectures also, and if at all you have missed that, then November 22 RTP revision test paper, the video of which is available on YouTube, you can refer the first question of that where a detailed question has been solved by us. However, the government on 18th of January 2022 has prescribed a notification number 8 of 2022 where most of the points are repetitive in nature, but one or two points are new, so we will go through this notification. As you are aware friends, that before 1st February 2021, in case any assessee purchased any insurance plan, be it a traditional plan or be it a unit linked plan, in either case we checked whether the premium exceeded 10% of sum assured. If the premium exceeded 10% of sum assured, then the gain arising was taxable in the hands of assessee. The gain would naturally arise either on maturity or at the time of surrender. However, if the maturity was on account of death of the assessee, then that is exempt from tax. So to put it in other words, if the premium did not exceed 10% of sum assured, then the gain arising on maturity or surrender of such policy was exempted from tax. For people with disability, this percent was 15 instead of 10. However, government witnessed that many people, HNIs especially, were purchasing ULIP plans where the whole objective was to invest in stock markets, but the whole product was disguised as an insurance plan. As a result, people were claiming exemption under section 10 clause 10D by making sure that the premium did not exceed 10% of sum assured. The insurance companies also came out with policies in such manner where the premium was exactly 10% of sum assured. So in order to defeat this kind of tax avoidance, government said with effect from 1st Feb 2021, in case any assessee purchases ULIP where the premium per annum exceeds 2,50,000, then the gain arising on that will be treated as capital gain irrespective of whether the premium exceeds 10% of sum assured or not. It will be treated as capital gain. Government was also mindful that in India, people would try to again find a loophole by making sure that they break down the policies in such manner that no individual policy premium would exceed 2,50,000. So let us say I want to invest in a ULIP where the premium is 3 lakhs. Then instead of purchasing one ULIP of 3 lakhs, I would break it down into two ULIPs of 1,50,000 each. Even that should not be possible. As a result, government inserted fifth proviso to section 10 clause 10D, where they said in case the assessee purchases multiple ULIPs, the aggregate premium of which exceeds 2,50,000, then the exemption under 10 clause 10D shall be restricted only to such ULIPs where the premium does not exceed 2,50,000. Also, please remember friends, even if your ULIP premium exceeds 2,50,000, but the maturity is due to death of the assessee, then the maturity proceeds will not be taxable. So as far as maturity proceeds on death are concerned, be it a policy where premium exceeds about 10% of sum assured, or be it a ULIP where premium exceeds 2,50,000, that will continue to be exempt because death cannot be used for tax planning. That's the whole idea. So over here in this notification, what the government has done is they have given various examples in order to clarify on this point. What we can do is we can quickly refer those examples, that is, as far as our sheet is concerned, reproduced under the chapter deductions from gross total income. Now what are these examples? They have clarified the same thing as I told you. If there is a single ULIP or multiple ULIPs, and exemption in case of death, that also we are aware, and various scenarios are given. So example number 1, now you look at this plan. Here the date of issue is 1st April 2021. So first and foremost we need to be satisfied that the date of issue is on or after 1st February 2021. Why 1st February? What is the significance of 1st February? That is the date when budget is presented. So here definitely the date of issue is after 1st February 2021. The annual premium is 2,50,000, sum assured is 25 lakhs, consideration received on maturity is 32 lakhs. Will this be taxable? Absolutely not, because the premium does not exceed 2,50,000 and the premium does not exceed 10% of sum assured. Had the premium on ULIP exceeded 2,50,000, then capital gain would have arisen because that would have been regarded as capital asset. But here the premium does not exceed 2,50,000, so there is no question of any taxability. You can read the answer. Second example, here the date of issue is 1st April 21, annual premium is 5 lakhs, sum assured is 50 lakhs and consideration of maturity is 60 lakhs. Will this be taxable? Yes, because the date of issue is on or after 1st February 2021 and the premium paid exceeds 2,50,000. So in this case the exemption would not apply, the maturity proceeds shall be taxable in the hands of assessee. So let us say for 10 years the assessee has paid 5 lakh rupees, so his investment is 50 lakhs and then he has received 60 lakhs. So government has prescribed a formula A minus B. A minus B means A is the amount received on maturity and B is the aggregate of premium paid. So 60 minus 50, that is 10 lakhs would be taxable. Government also recognized the fact that there may be some ULIPs where you may get some amount on a particular milestone and balance amount on maturity. So let us say I purchase a ULIP today, on the expiry of 10th year I get 10 lakh rupees or maybe a crore of rupees, and after 15 years I get 50 lakh rupees. So on 10th year I will apply the formula A minus B. A stands for 1 crore, the amount which I receive. B stands for the premium paid up till those 10 years. And C minus D will apply at the end of 15th year. That is the formula when subsequently I receive the amount. C stands for the amount received at the end of 15th year, of course excluding the amount which is already taxed at the end of 10th year. And D stands for the premium from year 11 to year 15. That is, D would be the premiums aggregate of premiums excluding the premiums contributed from year 1 to 10 or which is considered in point B already. So over here example number 2 I hope was clear. Now comes the question when there are more than one eligible ULIP. I would request you, please do refer that first question from November 22 RTP, because a detailed question which contains MCQs we have already solved, but still just for emphasis I am going through these examples as well. Now look at example number 3. Example number 3, there are two ULIPs A and B. The date of issue is after 1st February 2021. The annual premium is 1 lakh and 1,50,000 for A and B respectively. Sum assured is 10 lakhs and 15 lakhs respectively. Consideration received is also given. Now over here, please understand the entire policies will be exempt under section 10 clause 10D. Because when you have multiple ULIPs, the exemption would be restricted to those ULIPs where the aggregate premium does not exceed 2,50,000. So here aggregate of A plus B put together does not exceed 2,50,000, and therefore I would say that both the policies A and B are exempt. Suppose there was a third policy also, let's say policy number C, where the premium was 1 lakh. Now the question arises, sir, you said exemption would be limited to those policies where aggregate premium does not exceed 2,50,000. So let us say there is a policy number C and the premium for policy number C is 1 lakh. Now I would check, there would be multiple combinations because A plus B can be taken as one combination, that is the amount of aggregate premium does not exceed 2,50,000, or B plus C, again B plus C, the combination results in aggregate premium not exceeding 2,50,000, and A plus C where the aggregate premium is 2 lakhs. Which of the combination will I choose as exempt? Naturally I will choose that combination as exempt where the taxable amount is the minimal. That would be the basis of my choice. Over here there are only two policies, aggregate does not exceed 2,50,000, therefore the aggregate of A plus B will be exempt from tax. That is the consideration received whenever the policy matures. Next example, now here you see there are three policies, but please concentrate on the annual premium figure. Policy number C is definitely taxable. Here I don't need to see any combination because policy number C individually only the premium is exceeding 2,50,000. In no combination it can so happen that I include policy number C and that is exempt, because policy C by itself the premium is 3 lakh rupees. So will policy number C be exempt? No, 10 clause 10D will not apply because this is taxable. Definitely taxable because the premium individually exceeds 2,50,000. With regard to policy number A and B, I need to apply the exemption because the premium does not exceed 2,50,000 individually. I need to apply the exemption to such combination where the aggregate premium does not exceed 2,50,000. So here A plus B put together, the premium does not exceed 2,50,000 and the sum assured is 10 times of premium. Therefore, policy A and B shall be exempt from tax. So over here I will say in this case the aggregate of annual premium for A, B and C exceeds 2,50,000 during the terms of the policy. However, the consideration received for A and B would be exempt since the aggregate of annual premium payable for these two policies does not exceed 2,50,000 for any previous year during the term of these two policies and also does not exceed 10% of actual capital sum assured. Consequently, the consideration of ULIP C alone would not be exempt under section 10 clause 10. I hope this example is also clear. There are several examples. Let us quickly try and go through that. Example number 5. Now you see there are 4 policies. Policy X, policy A, policy B and policy C. You know, in examination conditions, one of the things which always happens is we don't read the question properly. Over here, please observe that X has been issued on 1st April 2020. That is before 1st February 2021. The amendment does not apply for policy X. So with regard to policy X, even though annual premium is 2,50,000, I cannot include it for considering the aggregate limit of 2,50,000 because that provision does not apply to this ULIP. All that I need to check is whether the premium does not exceed 10% of sum assured, which is the case. Therefore, policy X will be exempt under 10 clause 10D because here the amendment of ULIP 45(1)(b) does not apply. Now we are left with policy A, B and C, out of which again policy C would be definitely taxable because the premium by itself exceeds 2,50,000. So over here the exemption will not apply, and with regard to A and B, I am left with only one combination, A plus B, the aggregate of which does not exceed 2,50,000, and therefore A plus B shall be exempt from tax. Consequently, I can say X, A, B are exempt, C is taxable. You can go through the answer please. So as I told you, X would be exempt, A, B, C, only C will be taxable, so exemption will not apply. A plus B, the aggregate premium does not exceed 2,50,000, so that will be exempt. Next one. Now here the government has given a scenario where you have got multiple ULIPs, out of which some are maturing earlier and some are maturing later. So let us say I have got policy A and B. Policy A is going to be valid for 10 years and policy B will mature after 12 years. In such scenario, how will I apply this particular rule? So please let us look at the next example on this. Over here, example 6, the date of issue is after 1st February 2021. The annual premium is given to me as 2,50,000. Sum assured is given to me, and they have said that consideration is received in 2031 with regard to policy X, 25 lakhs, and in 2032 with regard to policy A. Over here, how will I apply the exemption? I have to check exactly the same things as I have done up till now. That is, annual premium put together, is it exceeding 2,50,000? No. So the combination where the annual premium does not exceed 2,50,000 is exempt under 10 clause 10D, plus it is not exceeding 10% of sum assured. So both X and A will be exempt. So over here they say the consideration of ULIP X would be exempt under 10 clause 10D since annual premium does not exceed 2,50,000 and also does not exceed 10% of sum assured. The consideration of ULIP A will also be exempt since aggregate of annual premium of A and X put together does not exceed 2,50,000. Example number 7, now you see over here. The date of issue is given, annual premium X, it is 2 lakhs, A, it is 1 lakh. In both cases, the annual premium does not exceed 10% of sum assured. But then a question arises, both put together, the premium is exceeding 2,50,000. So both I cannot claim as exempt under section 10 clause 10D. Out of the two, I have to claim only one as exempt. So question arises whether I will choose X as exempt or I will choose A as exempt. And the answer is I can choose either, my choice. But I will naturally choose that policy where the exemption is maximum, or to put it alternatively, the tax effect is minimal. So X I have taken on 1st April 21, it is going to mature in 2031. So 10 years I have contributed 2 lakhs, I have contributed in all 20 lakhs and I am getting 25. So how much is the gain? 5 lakhs. As far as the second one is concerned, for 10 years I contribute 1 lakh. So 10 lakhs I have contributed, I am getting 12 lakhs. So 2 lakhs is the gain. Which one will I claim as exempt? Naturally X. The reason is because exemption is higher, so minimal tax cost. I can idiot proof my argument by also mentioning one thing. The money received in policy X is earlier. So, suppose it was reverse. Money received in policy A was earlier. And you claimed exemption of the 2 lakh rupees in 2031 for policy A, let us say. In this question, to 2032 you are receiving in policy A and policy X is maturing earlier. Let's say it was reverse. And policy A, when you received the money, you claimed it as exempt. Then next year you do not have a choice. Policy X will have to be offered to tax. Because already you have chosen out of the two policy A to be exempt. So whenever you are claiming an exemption, be mindful of the fact that although current year you may get an exemption, future year you may be paying tax on a larger amount. So you need to be a bit careful with regard to that. So over here you can read the answer. The consideration under ULIP X would be exempt under 10 clause 10D since annual premium does not exceed 2,50,000 and also does not exceed 10% of sum assured. The consideration of ULIP A will not be exempt since annual premium payable for A and X issued together, put together exceeds 2,50,000. I hope this example was clear. Next one, example number 8. Now here there are 4 policies. All are issued on or after 1st February 2021, so that is out of the way. In all cases, if you observe, the sum assured is at least 10 times of the premium, so that is also not an issue. Now the question arises, out of X, A, B, C, which one will be taxable? As far as C is concerned, policy number C, the premium by itself exceeds 2,50,000. So policy C exemption cannot be claimed because the ULIP premium is exceeding 2,50,000, as simple as that. As far as X, A and B are concerned, I can have the following combinations because in all cases you observe X, A and B. I want you to concentrate on these 3 figures, X, A and B. In all cases the premium is not exceeding 2,50,000. So which combinations can happen? Can I say one combination can be A plus B and second combination can be X alone. These are the only 2 combinations possible where the premium aggregate is not exceeding 2,50,000. Then naturally question arises, out of these 2 combinations, which combination will I claim as exempt? So for that I need to compute the gain. As far as X is concerned, I have contributed 2 lakh rupees for 10 years, so 20 lakhs, received 25 lakhs, so 5 lakhs is the gain. As far as A is concerned, I have contributed 1 lakh for 10 years and received 12 lakhs on maturity, so 2 lakhs is the gain. And as far as policy B is concerned, I have contributed 1,50,000 for 10 years again, so that is 15 lakhs and received 18 lakhs, so that is 3 lakhs worth of gain. So now I can say both are tax neutral because policy A plus B put together the gain is 5 lakhs, policy X also individually the gain is 5 lakhs. So naturally I would say whichever is received earlier, time value of money, whichever is received earlier, claim the exemption earlier. Why pay tax today? Pay tax later. So over here I would say policy X is exempt from tax and A plus B do not claim the exemption. So X is the only one which is exempt. Let us see the answer. It says the consideration received under X would be exempt under 10 clause 10D in AY 32-33 since annual premium does not exceed 2,50,000 and also does not exceed 10% of capital sum assured. In this case, the aggregate annual premium of ULIP A, B, C along with X exceeds 2,50,000 during the terms of these policy. Hence, consideration received for A, B, C will not be exempt. That is, they will be taxable. Alternate treatment: if consideration under ULIP X was not claimed to be exempt by the assessee, then A plus B put together will be exempt. As I told you, both are tax neutral. X also you can claim or A plus B also you can claim. I would prefer to claim X as exempt because that gain arises earlier. Fair enough. Next one. Over here again all policies are issued after 1st February 2021. If you see the annual premiums, I hope you understand, where single ULIP premium is exceeding 2,50,000, definitely taxable. So over here ULIP number C will definitely be taxable. So exemption not available. As far as X, A and B is concerned, none of the policy premium exceeds 2,50,000. So I need to check which combination is the best for me. The first combination that can happen is X plus A. Second combination that can happen is A plus B. And the third combination that can happen is X plus B. I will choose that combination wherever the tax benefit is the maximum. So over here, concentrate on X. X, the annual premium is 1 lakh for 10 years. Because I have issued it in 2021, it is going to mature in 2031. So 10 years I contributed 1 lakh, I am getting 12 lakhs. So 2 lakhs is the gain. Policy number A, I contributed again 1 lakh for 10 years, I am going to receive after 10 years 12 lakh rupees. So again it is 2 lakh rupees gain. And policy number B, I have contributed 1,50,000 for 10 years. So that is 15 lakhs. I am receiving 18 lakhs. So 3 lakhs is the gain. So X plus A combination gives me a figure of 4 lakhs. A plus B combination gives me a figure of 5 lakhs. X plus B combination gives me a figure of 5 lakhs. So the answer is that I can choose either the combination A plus B as exempt or I can choose X plus B as exempt. Either of the two. There are two treatments possible. Usme se which one is maturing earlier? X is maturing earlier. So I might go in for X plus B as my combination. Let us read the answer. But remember one thing, C is definitely taxable because there the premium is exceeding 2,50,000. So over here it says the consideration under ULIP X would be exempt under 10 clause 10D in AY 30 to 33 since premium does not exceed 2,50,000 and also does not exceed 10% of capital sum assured. In this case, the aggregate annual premium for A, B and C along with the premium of X exceeds 2,50,000 during the terms of these policies. However, the consideration received under ULIP A or B, any one, can be claimed as exempt under in AY 33-34. So that is, they are saying the combination of X and B because there the gain is maximum. If I take X and A, that makes no sense because there the gain is lower, so my tax benefit will be lower. So I would choose X and B. Alternatively, I can choose A plus B as well, as they may have stated ahead. Alternative treatment. If the consideration under ULIP X was not claimed to be exempt under 10 clause 10D, then consideration received under A and B would be exempt under 10 clause 10D since the aggregate annual premium for A and B put together did not exceed 2,50,000. So I need to compute the gain on each of the ULIPs and naturally I will choose wherever the gain is maximum. ULIP C definitely is not exempt because the premium itself exceeds 2,50,000 on that policy. I think this is the last example, example number 10. This, as I told you, is from the severity circular. Now over here all policies are issued on or after 1st February 2021. Out of this, if you look at the annual premium figure, now you should be able to tell me which of the policies is definitely taxable. Policy C is definitely taxable because the premium exceeds 2,50,000 rupees. So C is definitely taxable. Taxable means exemption nahi aavse, not applicable. So this will definitely not be exempt, it will be taxable. Now remains policy X, Y, A and B. Here question arises which combination is possible. all four put together definitely exceeds 2,50,000. So X plus Y plus A plus B is not a combination which is possible. Three policies put together also not possible. If you have a cursory glance at the figures, any three policies put together also the premium will definitely exceed 2,50,000. So I have to take combination of 2. So that can be either X plus Y or Y plus A. X plus Y annual premium will be 2 lakhs, Y plus A annual premium will be 2 lakhs, or A plus B, or then it can be even X plus B or Y plus B or A plus B. Now question arises, 6 combinations possible. Am I repeating anyone? Yes, A plus B I am repeating. So 5 combinations possible. Now a question arises, what is the gain on each individual policy? As far as X is concerned, I have surrendered this policy on 1st of July 2025. So I took the policy on 1st April 21, contributed premium for 4 years, 2021, 22, 23, 24 and 25. 1st April 2021, 1st April 2022, 1st April 2023, 24, 1st April 2025. 5 years I contributed 1 lakh, so that is 5 lakh rupees. I received 6 lakhs, so that is 1 lakh rupees worth of gain on this policy X. Policy Y, I have contributed 1 lakh for a period of 10 years and then received 12 lakh rupees, so that is 2 lakh worth of gain. Policy A, I again contributed 1 lakh premium for a period of 10 years, so that is 10 lakhs, I received 12 lakhs, so that is 2 lakhs worth of gain. And policy number B, I contributed 1,50,000 for 10 years and received 18 lakhs, so that is 3 lakhs worth of gain. So naturally in my combination of whatever I claim exempt, B should be there because B has the maximum gain. So B should be there, and out of Y and A, I can choose either. So either Y plus B or A plus B. Either of the two combinations can be claimed as exempt. So let us say A plus B is exempt, then X will be taxable and Y will be taxable. I hope you understand why B is definitely required and why X is definitely not required. B is definitely required, gain is maximum. X is definitely not required because gain is minimum. X पे tax pay कर दो, B पे exemption लेना है. But suppose because this amount is received earlier, you claimed exemption on this, then naturally you are choosing the option which is not in your interest. So let us read the answer. It says the consideration under ULIP X would be exempt under 10 clause 10D since the annual premium does not exceed 2,50,000 and also does not exceed 10% of capital sum assured. You can claim, but that is not in your interest. The consideration under ULIP Y would be exempt under 10 clause 10D since aggregate annual premium for X and Y does not exceed 2,50,000 and annual premium payable for ULIP Y does not exceed 10% of sum assured. Consideration of A, B and C would not be exempt since annual premium exceeds 2,50,000. Alternate treatment. If X was not claimed to be exempt, then consideration under Y, ULIP Y would be exempt and ULIP A or B, any one, can be claimed as exempt in AY 33-34. If the consideration of ULIP A is claimed to be exempt, as aggregate premium of Y and A did not exceed 2,50,000, consideration of B would not be exempt. If the consideration of B is claimed to be exempt, then Y and B did not exceed 2,50,000, then A would become taxable. As I told you, any two can be claimed as exempt. There will be a combination of 2. I would naturally answer in such a way that exemption is being claimed wherever the gain is the highest, because if gain is the highest, tax saving is the highest, tax cost becomes minimal. I hope this concept is clear to everyone. I say this at the cost of repetition. Please do refer the November 22 RTP. A similar type of question has been solved by us in detail. Proceeding to the next amendment. This is the amendment in section 47 clause 7AB. As you know that in order to promote local businesses in India, and in order to invite foreign investors to set up businesses in India, Government of India has come out with the concept of International Financial Services Center, IFSC, and there are certain benefits provided for those people who carry on business in IFSC, provided the transaction should be carried out in foreign currency. One of the exemption is that STT would not be payable, securities transaction tax, if you transfer any securities in IFSC, stock exchange located in IFSC. Similar to that, if you transfer a bond or GDR, global depository receipt, or a rupee denominated bond, or a derivative, or any other prescribed securities, and the consideration is payable in foreign currency, then the transaction would not be regarded as transfer. In short, I would say capital gain tax will not apply. Which are the other prescribed securities that has been notified by government through a notification of August 2022? These are foreign currency denominated bond, unit of mutual fund, unit of business trust, foreign currency denominated equity share of a company, unit of alternate investment fund, and bullion depository receipt with underlying bullion. If all these are transferred in IFSC and consideration is payable by a non-resident in IFSC and consideration is payable in foreign currency, then this is not regarded as transfer. I hope this was clear. Let's move ahead to the next amendment now, friends. This is regarding relocation of a fund. We have covered this provision when we were doing our paper 7 portion. Only one small update is there as far as section 47 clause 7 AD is concerned. If you remember, if there is a relocation of a fund which was established outside India into International Financial Service Center, then this transaction is regarded as tax neutral. There would not be any tax on the fund as well as its unit holders. Here the government has just added one condition, that in such fund which is getting relocated in India, the aggregate participation in the original fund which is going to get relocated to India in IFSC by person resident in India should not be exceeding 5%. So the maximum holding by Indian residents in such original fund should be 5%. Only then this exemption will apply. Okay. Other conditions are the same, there are no changes. The next amendment is in section 56 subsection 2 clause 7b, and that is income from other sources chapter. Now if you remember this section, I have told you that when any company which is a closely held company or a company in which public are not substantially interested, if they are issuing shares at a premium, then the issue price in excess of fair market value of the share shall be considered to be the income for the recipient company. So let us say I have a company where my fair market value of shares is 12 rupees, but I issued shares to someone and I got 20 rupees per share. Government says, bhai, aapki net worth demanded that you get only 12 rupees. So how did you get 20? So that 8 rupees excess would be taxable in my hands. Now here certain exemptions are given with regard to startups, venture capital funds, etc., etc. Like that, now the government has added that if a specified fund, that is a company which is incorporated as category 1 or category 2 AIF in IFSC, then such company issuing shares will not be subjected to 56 subsection 2 clause 7b. So if a specified fund issues shares at a premium, you don't need to compare it with the fair market value of shares. But all others, that is a relaxation given for those funds. For all others, if I float a company, if you float a company, your parents float a company, and they issue shares at a premium, you need to be mindful that if the issue price exceeds fair market value of shares, the excess would be taxable in the hands of the company which is receiving such premium. Also friends, in income from other sources, another amendment has been made in section 56 subsection 2 clause 10. Now what was 56 subsection 2 clause 10? If any person receives from any other person either money or property, without consideration or for inadequate consideration, then the value of benefit, if it exceeds 50,000, will be taxable in the hands of recipient. So let us say that I have purchased a property worth 1 crore rupees for 10 lakh rupees. Property is worth how much? 1 crore. I got it for how much? 10 lakhs. Is there a benefit to me? Absolutely yes. A property whose stamp duty value is 1 crore, I am getting only for 10 lakhs. So 90 lakhs is the benefit arising to me. That would be taxable in my hands. Or let us say somebody gifted me, sir, your DT lecture, wow, fantastic, 10 lakh rupees. Now that is of course a benefit to me. I am getting the money without consideration. So in such case, that amount would be taxable in my hands. Over here friends, the amendment in the current year is again with regard to COVID. Because during COVID you must have noticed that very unfortunate scenes, very unfortunate, let me highlight that first, that in your building there is a watchman, the building has suddenly told him that boss, we don't need your services, or maybe we need your services at half pay, because there was cost cutting all around. Or maybe those people who had cars in the building, the person who comes in the morning to wash the cars, or in general some maid servant or some person you have heard a story of, people were generous enough, most of them were generous enough to contribute some amount to such kind of people. Or you notice that suddenly a neighbor is in need and you maybe help that person by giving some money. Technically speaking, such amount is received without consideration. So the government was mindful that for all those people who are receiving such help during COVID, unnecessarily, without intention, tax consequences may arise under 56(2)(10). As a result, government has inserted an exception for those people who have received money in respect of expenditure actually incurred on medical treatment for illness related to COVID-19. Certain conditions are prescribed. First and foremost, the COVID-19 positive report of the individual or family members, if clinically determined to be COVID positive through investigations, shall be maintained by that assessee, and all necessary documents of medical diagnosis or treatment suffered within 6 months from the date of being determined as COVID positive. The details of this amount so received in any financial year has to be furnished in form number 1 to the income tax department within 9 months from end of such financial year or 31st December 2022, whichever is later. One question which many students asked me in class was that if the government wants to give a benefit or a relaxation by not applying 56(2)(10), then why is it that they are prescribing so many conditions? Because I hope you understand friends, in India we have unscrupulous elements who are always willing to misuse any kind of relaxation. That's an unfortunate part of our country. So as a result, government has to make sure that conditions are also prescribed. It's like terms and conditions apply. Further friends, government also said that in case a member of the family of a deceased person receives from the employer of the deceased person, so some person who was working as a driver, suddenly unfortunately during COVID he died, so the employer gives some compensation to his wife or family members, or from any other person if the aggregate amount does not exceed 10 lakhs, where the cause of death is related to COVID-19 and the amount of compensation is received within 12 months from date of death. In that case, 56 subsection 2 clause 10 will not apply. Here certain conditions are prescribed which are same as what we saw earlier. You have to maintain all the reports relating to COVID. Fair enough. After this friends, as far as set off chapter is concerned, section 79, this I have covered thoroughly in class. Here as such no amendment by Finance Act 2022, except that they have added a new section 79A. 79A talks about no set off of losses being allowed against undisclosed income. So if at the time of a search or a requisition or a survey, there is some incriminating evidence against you. Incriminating means something that establishes guilt. पकड़े गए, आप रंगे हाथों पकड़े गए, and there is some evidence to show that you have black money, undisclosed income. Now, if you try to claim set off of some loss or some expenditure against such income, then that will not be allowed. That is all that this section clarifies. Why this clarification was required? Someone might say, sir, under section 115 BBE, already it is stated that the gross income will be taxed at 60%. But please remember friends, that is given in rates of tax. There was no such corresponding provision in set off and carry forward of loss chapter. So government has just brought the provision to make it at par that even set off carry forward chapter denies you any benefit and the rate of tax will be applied as it is on the gross income. So during the course of search survey, if any incriminating document is found or any undisclosed income is found and which has to be taxed at 60% under 115 BBE, against that no set off of losses shall be allowed to you. I hope this amendment is clear. The next one, 10 clause 10D, I have already covered, we saw the examples as well. Next one is deduction under section 80 CCD subsection 2. We all know that as far as national pension scheme is concerned, the employee out of his salary contributes some amount towards national pension scheme, and at the same time the employer contributes from his own pocket some amount towards the NPS. The maximum deduction that is allowed, because as such the employer on my behalf from his pocket is directly contributing to NPF, so that is a benefit to me, it is added to my salary, and corresponding amount is allowed as a deduction, but maximum deduction that is allowed is 10% of salary, maximum. However, if the employee happens to be a government employee, then the deduction allowed is 14% of salary. For government employees, you need to understand, prior to 2004, someone may say for private sector 10%, for government employees 14%. Why? Because prior to 2004, the government had something called as the old pension scheme. The old pension scheme did not have all this NPS ka concept. Rather, when the employee retired, government servant retired, the government out of its own pocket used to give a pension to that retired person. In the year 2004, government realized that our pension cost is far exceeding the salary which we are paying to the active employees, which is not a good situation. So in the year 2004, government shifted to the new pension scheme. It is very unfortunate, now it is being used for political reasons. Many political parties are promising that they will shift back to the old pension scheme, because government employees ke liye that was very much beneficial. But you need to understand, it's a cost to the exchequer. In our country, we only know about our rights. We do not understand responsibilities. I mean, I am not talking of everyone, some people. We want all kinds of perquisites and benefits from government, but we do not realize that it burdens the government exchequer with a cost. So 2004, government shifted to the new pension scheme for government employees. So naturally, government employees were a bit disgruntled. So in order to compensate them, government said, fair enough, I will contribute 14% of salary, and corresponding 14% of salary you will get as a deduction, so that after your retirement, a bit higher amount is eligible to you as pension. So for private sector employees, the percentage is 10, and for the deduction allowed under 80 CCD subsection 2, and for government employees it is 14. Sir, what is the amendment this year? The amendment this year is that earlier this 14% was eligible only for central government employees. This year they have added state government employees as well, because political parties during state elections are promising that we will revert to the old pension scheme, without realizing that it will unnecessarily burden the state government's exchequer over a period of time. I don't want to get into the economics of it, because that's not the topic of discussion, But now in order to incentivize state governments also to remain in the new pension scheme, government has added state government employees. For state government employees also, the deduction allowed shall be 14% of salary. Okay. Next is deduction in respect of maintenance including medical treatment of a dependent disabled. This provision we have already covered when we did the deduction under chapter 6A, so not very relevant. As far as ATIAC is concerned, eligible startup, we know that eligible startup means a company or LLP which is engaged in eligible business incorporated between 1st April 2016 to 31st March 2022. Government has extended that date. Now if a startup is created incorporated up till 31st March 23, then also they are entitled for this benefit. Deduction under section 80 LA subsection 2, over here also the government has extended the date to 31st March 24. Fair enough. Next one is assessment of various entities. Section 115 BAB. Now this section, as we know, is part of the new regime of taxation applicable for domestic companies. Section 115 BAA applies for any domestic company, be it a old domestic company or a new domestic company. The rate of tax is 22% plus 10% surcharge and 4% cess. Whereas section 115 BAB applies for a newly incorporated manufacturing company and the rate of tax over there is 15% plus 10% surcharge plus 4% cess. Now one of the conditions given in that section was that such manufacturing company should commence its production before 31st March 2023. So in short, it should be incorporated on or after 1st October 2019 and it should start its operations on or before 31st March 2023. This year the government has extended the date and they have made the date as 31st March 2024. That's the only amendment in section 115 BAB, otherwise rest of the things are the same. Next one is section 115 BBD. Now what is section 115 BBD? Up till last year, that is FY 21-22, if dividend was received from a specified foreign company, then such dividend on gross basis was taxable at 15%. So in short, you are an Indian company, the assessee is an Indian company, it is investing in a specified foreign company. What is specified foreign company? Any foreign company in which the Indian company is holding at least 26% shares carrying voting power. So you are holding 26% in such company and that company gives you a dividend. So in order to encourage repatriation of money into India, the government said we will tax such dividend at a concessional rate of 15%. No deduction was allowable against such dividend income. But this year the government has deleted this section 115 BBD. Now dividend received from a foreign company and dividend received from a domestic company are treated at par. Both will be treated as part of your normal income. There is no concessional tax rate even if dividend is received from a foreign company. Let me also mention over here, we have done a deduction under section 80M, M for Mumbai. In that deduction, if an Indian company receives dividend from another domestic company or from a foreign company and it distributes dividend before the due date to its shareholders, then a deduction is allowed under section 80M. So there also we can see that dividend received from a domestic company and foreign company are being treated at par. That's the reason why this concessional tax rate under section 115 BBD has been deleted with effect from this year, that is AY 23-24. Next is taxation of virtual digital asset. Now this entire chapter is an amendment. Up till last year there was no taxation of virtual digital asset at all. This year this entire chapter has been introduced and during our lectures we have covered this as a separate chapter itself. The chapter itself is separate. So I would not discuss this amendment because you can refer that particular chapter. That chapter itself acts as the amendment. There are various provisions over here, like what do you mean by virtual digital asset, how its taxation mechanism is covered. It will be taxed at 30%, the income from virtual digital asset. No deduction or set off will be allowed against such income. And more so, I would say important provision is the TDS provision, which has been introduced with effect from 1st July 2022. Clarifications have been given by CBDT in connection with virtual digital asset. All of that we have covered in detail when we did our portion. After that, friends, after 194S, that is TDS with regard to virtual digital asset, the next one is reduction of alternate minimum tax for cooperative societies. So as far as cooperative societies are concerned, the government has brought about the alternate minimum tax rate at par with MAT. So now the alternate minimum tax with regard to a cooperative society is 15% instead of 18.5. Please remember, alternate minimum tax for other assessees continues to be the same, that is 18.5. With regard to only cooperative society, it has been brought down to 15%. And the reason for that is that there are many cooperative societies like Amul or many milk producing cooperative societies. Like in Maharashtra, there is a cooperative society called as Varna. All these cooperative societies compete with international companies as well as various domestic companies. So the tax treatment has been brought at par with the treatment provided to a domestic company. So since MAT rate is 15%, similarly over here they have brought about the alternate minimum tax rate down to 15% for cooperative societies. Next one is relief from taxation in respect of income from retirement benefit account maintained in a notified country. Now please remember, friends, as you may be aware, in your neighborhood or some of your relatives or even within your family, there may be situations when people go outside India and work in foreign countries like USA, UK, Canada. After their retirement, they come back to their home country, that is India. Now in those countries, when they are working over there or when they are doing their job or occupation, a retirement benefit account is created by their employer. Over the course of their employment, contribution is made to those retirement benefit account, and thereafter post retirement they can withdraw money from those accounts for the purpose of sustenance. Now as far as those retirement benefit accounts are concerned, especially if I talk about US, the tax provision in US says that only when a person withdraws from the retirement benefit account, a tax effect will arise with regard to that particular withdrawal. So let us say I have worked 40 years in US, let's say in police department. Now I have retired, I come back to India for good. I have got a corpus in the retirement benefit account of 1 crore rupees. Every year naturally in that retirement benefit account on my corpus interest will be earned, but that is not taxable in my hands until and unless I withdraw from that account. So let us say year 1 after my retirement, I have come back to India. I now become a resident and ordinary resident in India. There is accrual in that retirement benefit account, but in US that is not subjected to tax because I have not yet withdrawn from that account. But as far as India is concerned, we tax pension, which is considered as part of salary, on receipt or due basis, whichever is earlier. So although in the US this retirement benefit account accruals is not getting taxed, But in India, it would be subjected to tax because there is accrual in that account and you are resident in India, so global income is liable to tax. So you pay tax on those accruals in India in year 1. Now let us say in year 6, you are withdrawing from that retirement benefit account, again the amount gets taxed in US. So this leads to a double taxation. As a result, government has introduced section 89A with regard to notified countries. Which are the countries notified till now? US, UK and Canada. Wherein the government states that if you happen to maintain a retirement benefit account in those notified countries, you are a resident in India now, that is you are a resident in India right now, but that account was opened in the country when you are a non-resident, means you are working over there. And such account, the income on those accounts is not taxed on accrual basis but is taxed at the time of withdrawal or redemption. In such case, the assessee can exercise an option saying that I want to pay tax on such income in India only at the time of withdrawal or redemption. You have to intimate the CBDT saying that I do have an account outside India. Today I am a resident, so my global income is liable to tax. But because US, UK or Canada is going to tax this accrual on my retirement benefit account at the time of redemption, I would like to pay tax in India also at the time of redemption. You might ask me, what is the benefit? The benefit is that whatever tax then you pay at the time of redemption in US, UK or Canada at the time of withdrawal would be eligible as foreign tax credit in India. So double taxation is prevented. Because earlier there was a mismatch that in India it was getting taxed in the year of accrual, but in those countries it was getting taxed in the year of withdrawal. That was resulting in an anomaly. That anomaly has been done away with by introduction of section 89A. I hope this amendment is clear to everyone. After this, as far as the next chapter is concerned, charitable trust. One of the favorite chapters of government to create a lot of amendments is charitable trust, without any doubt. In fact, many a times Bombay Chartered Accountant Society or your WRC, when they have post-budget lectures with regard to amendments, with regard to new things introduced in the budget, and if the topic happens to be on charitable trust, the heading or the invitation always says the topic would be uncharitable amendments in charitable trust, something like that, because many complex amendments are made in charitable trust. All those amendments as such we have already covered during the course of our lectures. But two important amendments I would like to highlight over here. The first is that in Finance Act 2022, for the first time, government has used a different terminology with regard to charitable trusts. That is, they have called it trust under the first regime and trust under the second regime. First regime is defined as those trusts which are availing the benefit under section 10 clause 23C, and second regime is defined as those trusts which are availing the benefit of section 11. There were lot of anomalies between section 10 clause 23C and section 11. Let me give you one example. Up till last year, as far as a trust which is registered under section 10 clause 23C is concerned, they could accumulate their income. We know that accumulation of income can be done for 5 years. You have to make an application to the AO. The AO shall grant you approval for accumulating the income. Within 5 years, you have to utilize the accumulated amount for the purpose for which the accumulation was done. Up till the time utilization is done, the amount must be kept in specified investments. And if you do not utilize it within maximum 5 years, then in the 6th year it will be added to your income. But those provisions regarding accumulation, that is the conditions, applied only for a trust which was registered under section 11. As far as those trusts which are registered under section 10 clause 23C is concerned, there was no such provision. A trust registered under 10 clause 23C could accumulate the income on its own, no need to approach the AO. So government said this is an anomaly. We don't want to create such kind of loopholes in law which can be misused by the assessees. As a result, the government has now harmonized the provisions and made sure that under both regimes, more or less the conditions are the same. So that is first amendment with regard to charitable trust. The second one which I want to discuss is a new section introduced by government, that is section 115 BBI. Again, that section has been discussed in classroom, but still it's an important section. I expect a question on this in exam. Section 115 BBI says taxation of specified income of NPOs chargeable to tax by charitable trust or institutions. Now, certain situations are granted in this section 115 BBI, and the provision says that if income arises in those specified situations, then such income would be chargeable to tax at the rate of 30%. Which are those specified situations? Suppose you have accumulated income in excess of 15% where the accumulation is not allowed under any specific provision of law. As we know that if a trust earns 100 rupees, it is required to spend or it is required to apply only 85 rupees out of that. 15 rupees is allowed as automatic accumulation. And the reason for that is, we know that trust normally depends on voluntary contributions, that is donations made by various donors. Every year you cannot expect the donation amount to be the same. Unlike a corporate, a trust cannot provide projections that this year I had got 100 crore worth of voluntary contribution, next year I anticipate year on year 20% growth. It is another fact that some trust runs like corporate. There are various trusts in India which may be running like corporate. But a trust normally cannot do that. Normally they cannot envisage how much donations they are going to receive in future. So for such years when their income may suffer on account of various reasons, the government says every year whatever income you are getting, keep accumulating automatic 15%, no conditions attached, no terms and conditions. But yes, if you accumulate more than 15%, which is not allowed under law, then section 115 BBI will be attracted. Second is, suppose there is a deemed income on account of violation of conditions stipulated for accumulation of income. As I told you right now, that under 1023C first regime and section 11 second regime, post amendment where we have harmonized the provisions, for accumulating any income, you are required to satisfy the conditions provided in section 11. That is, you have to make an application to the AO. AO has to be told the objects for which accumulation is made. The AO shall grant you the permission for accumulating. You have to keep that accumulated amount in specified investment, not like you can take that money and put it in cryptocurrency. You will have to invest in specified securities. Suppose any of those conditions are violated, then the income will be taxed under section 115 BBI. Or suppose there is a deemed income on account of violation of deemed application provisions under section 11 subsection 1B. As we know that suppose you are not able to spend your income in the current year because maybe the income is accrued but it has not yet been received in your hands, or maybe due to any other reason you are not able to apply your income, then you can apply such income in the immediately succeeding year. However, you have to mention that to the assessing officer, intimate that to the assessing officer by furnishing form number 9A before the due date of furnishing return. Suppose you do not apply that amount in the next year also. You told the AO that year 1 I have got this 100 lakhs income, I was required to spend 85 lakhs, I have spent only 60 lakhs due to whatever reason, 25 lakhs I will spend in the next year. Now next year also you don't do that, section 115 BBI will be attracted. Any income which is not exempt under 1023C or section 11 on account of funds of the trust or institution not being invested in the mode specified in section 11.5. Whenever you get a corpus donation, whenever you get any voluntary contribution or any other income, section 11 specifies that you have to invest those incomes as per the specified investment mode under section 11.5. We have covered the list of specified investment during our lectures. Suppose you do not accumulate, you do not invest the money as per the specified modes, then section 115 BBI is attracted. Even if you grant benefit to a specified person, section 13 clause 3, we have covered the list of specified person and situations where benefit can be arisen to a specified person. If any benefit is granted to specified person, this section will be attracted. Any income derived from property held under trust for a charitable purpose which tends to promote international welfare in which India is interested, to the extent to which such income is not applied towards charitable purpose outside India. So you have been created for international welfare purposes, government has granted you registration, but you have not spent the amount for the objects for which you were created, then also this provision will be attracted. This is a very important provision, friends, section 115 BBI, very important from examination perspective. If any of these situations are attracted, then the resultant income will be taxed at 30%. No deduction, no expenditure, nothing will be allowed against this. The gross amount will be charged to tax at 30%. Also, please remember, friends, one more amendment with regard to charitable trust, if I may mention, that in section 11 they have added an explanation saying that application of income will be allowed to you only when the amount is actually spent. You cannot create a provision, you cannot make only a provision for expense and claim it as application. When you receive the income, you are required to actually spend the amount. That is also an important amendment in section 11. Fair enough, accreted tax we have covered in detail, no amendment with regard to that. Next, if I may proceed on to deduction, collection and recovery of tax. The first amendment in this chapter is provided in section 194I. Section 194I has granted an exemption. It says that there shall be no requirement to deduct TDS under this section on payment in the nature of lease rent or supplemental lease rent made by a lessee to a lessor being unit located in IFSC for lease of aircraft. Why is this exemption from TDS granted? Because the recipient, that is the lessor of aircraft, is entitled for a deduction under section 80LA. As a result, when he is going to get deduction, so his net income is going to be 0. So unnecessarily by deducting TDS, it will only result in blocking of working capital. So government says there is no need to deduct any TDS on this payment. Next one is the amendment under section 194IA, a very harsh amendment. Up till last year, in case I purchased any property, the consideration of which exceeded 50 lakh rupees, I was required to withhold 1% tax at the time of payment. So let us say I purchase a property in Borivali for 1 crore rupees. I am required to deduct or withhold 1% tax, that is 1 lakh rupees, deposit to the government, and 99 lakhs rupees will be paid to the seller. Of course, that 1 lakh rupees he will get a credit for that because it will appear in his form 26AS. But if the consideration did not exceed 50 lakhs, then in such scenario there was no need to withhold TDS. So let us say the same property I am acquiring for 48 lakhs. Now there is no need to deduct TDS. The amendment this year is that I would be required to withhold tax on the higher of agreement value or stamp duty value. If either of them exceeds 50 lakhs, then I am required to withhold tax at the rate of 1% on whichever is higher. So let us say a scenario as compared to last year where my agreement value is 48 lakhs, stamp duty value is 53 lakhs. Up till last year, I would say that since the agreement value does not exceed 50 lakhs, there is no need to withhold tax. But now in the current year, I need to say, look at whichever is higher, agreement value or stamp duty value. Which is higher? Naturally 53 lakhs is higher. Is this exceeding 50 lakhs? Of course, yes. So now on this amount, I am required to withhold 1% TDS. This is very harsh because in various scenarios, the stamp duty value may be unduly high. It is not necessary that stamp duty value always has to be a fair value. That's the reason why stamp duty value can be challenged. In front of the SRO's office, that is sub-registrar office, you can challenge the stamp duty value. But naturally that challenging of stamp duty value will take place after the agreement is registered. So at the time when the agreement is getting registered, I would be forced to deduct TDS on this higher value. Also looking at it from another scenario, in reality I am paying 48 lakhs to the seller. 5 lakhs is notional. The government is assuming it is a deeming fiction created in law. And on that deeming fiction, now I am required to withhold 1% TDS. But anyway, that's the way law has been worded. We can't do anything about it. So now I need to withhold tax under 194IA on the higher of agreement value or stamp duty value, provided of course the agreement value or stamp duty value, whichever is higher, exceeds 50 lakhs. Okay. Next is under section 194IB, there is no amendment, we have already done this. Section 194O, e-commerce operator, this also has been covered by us. The next important provision, again which I would like to star mark, is section 194R. This is deduction of tax at source with regard to any benefit or perquisite in respect of business or profession. What do you mean by a benefit or a perquisite? I have already explained this when we did PGBP chapter section 28 clause 4, but let me reiterate. Let us say in a hospital, a patient is about to undergo a surgery. The chances of survival are 50-50. The doctor performs that 12-hour long surgery and the patient is ecstatic. Apart from paying whatever is the hospital charges and doctor's fees, the patient gives some, maybe some gold watch or maybe some Bhagwan ka idol made of gold to the doctor, and he says this is, a token of my gratitude towards you. Now as far as the doctor is concerned, is this a benefit for the doctor? Absolutely yes. And that benefit has arisen in the course of business or profession. Or many a times it happens that suppose a company has got dealers and the dealer achieves a particular target. The company says at the beginning of the year itself, whoever achieves this target, we will give him and his family one trip to UK, return trip. He can go and come back. In fact, I do not know how many of you all watch that series called as Tarak Mehta. If you watch that, in one of the episodes it is given that this Jethalal, some television company is quite happy with him because he has achieved a sales target. So they tell him that you please go to UK and come back. These are all benefits or perquisites arising in the course of business or profession. Now naturally a question arises, how will the income tax department come to know that you have received some benefit or perquisite? Government says don't worry, with effect from 1st July 2022, if any person has provided any benefit or perquisite to another person, whether convertible into money or not, and arising from the business or exercise or profession by such resident, then in that case the tax has to be deducted at 10% on value or aggregate value of such benefit or perquisite. 10% TDS. But remember, this has come into effect from 1st July 2022. Our institute has a habit. Sometimes they will say that on 29 June so and so this benefit has been provided, you are required to discuss TDS provision. Will your answer change if the benefit was provided on 1st January 2023? So before 1st July, on benefit of perquisite there was no TDS. With effect from 1st July, there is a 10% TDS. However, if the value of benefit of perquisite does not exceed 20,000 rupees, then in that case there is no need to withhold TDS. Also, if the payer happens to be an individual or HUF whose total receipts from business does not exceed 1 crore or 50 lakhs in profession in the immediately preceding year, then such person is also not required to withhold TDS. Over here friends, one question which may arise is that what if the benefit or perquisite is in kind? Both examples which I gave, where the doctor is being given a watch or the dealer is provided with a air ticket, both are benefits in kind. So here the government says if the benefit is in kind, then before releasing that benefit, before providing the benefit, you are required to tell the opposite person that please give me amount equivalent to the TDS which I will deposit to the government and then provide you with the benefit of perquisite. Very uncharitable kind of amendment. Same thing is given in winnings, but here it becomes even more difficult to be implemented because you are providing a benefit. Now before providing benefit, you are required to tell that person, no, you please give me TDS ka amount, I will deposit to the government and thereafter I will release the benefit to you. Seems a bit unkind. Anyway, now in this context, CBDT has released a circular and various clarifications have been given. First and foremost, question number 1 which was asked was, is it necessary that the person providing benefit of perquisite needs to check if the amount is taxable under 28 clause 4 before deducting tax under 194R? Please understand this friends, please understand this. Suppose there is a professor who has taught you some subject in final CA, let us say. Now you have an eternal sense of gratitude that due to this person I was able to become a chartered accountant. So after clearing your exam, you provide that person with a small token gift and let us say the value exceeds 20,000, just for argument's sake. In such situation, for that professor, that benefit is arising in the course of his profession. But as far as you are concerned, the person who is giving that benefit is concerned, it is not possible for you to verify whether he is going to offer it to tax under the head business or profession. You know that he is my professor, his occupation is to teach. In the course of his business or profession, he has been given a benefit by me, but under which head of income will it be taxed, or will it be taxed at all or not? That is not possible for you to verify. So government says that when you are providing a benefit, you need not check whether he will offer it to tax under which head. That is not material. You know that this benefit is being provided to him in the course of business or profession, so TDS needs to be deducted, as simple as that. So I am reading the answer. It says no, the deductor is not required to check whether the amount of benefit or perquisite that he is providing would be taxable in the hands of recipient under section 28 clause 4. The amount could be chargeable under any other section like 41(1). Section 194R casts an obligation on the person responsible for providing benefit or perquisite to a resident to deduct TDS at 10%. There is no further requirement to check whether the amount is taxable in the hands of recipient or under which section it is taxable. I hope this clarification is clear. Then they say, is it necessary that the benefit or perquisite must be in kind for section 194R to operate? Now here I kind of disagree with the clarification given by CBDT, because in the context of section 28 clause 4, there is a Bombay High Court decision of Santojan Silk Mills, we have covered that in class, where Bombay High Court said that the section uses the word any benefit or perquisite whether convertible into money or not. When it says whether convertible into money or not, originally that benefit or perquisite has to be non-monetary in nature. The same wording is used in section 194R. But when CBDT was asked a question that whether the benefit must be only in kind, they say that no, tax under 194R is required to be deducted whether the benefit or perquisite is in cash or kind. According to me, this clarification is not correct. But CBDT circular as it is not binding on us. The assessee can very well challenge it. And let me tell you, there is a tacit admission by government itself that this clarification is erroneous. Because Finance Bill 2023, when presented in Parliament, has brought about an amendment in section 194R, and they have changed the wording. Instead of saying benefit or perquisite whether convertible money into money or not, they have now changed the wording saying that whether in cash or in kind. So what was the need to change the wording? If the understanding was this, then why is it that government was required to amend the provision? Because government also knew that courts will hold that monetary benefits are not covered under 194R. As far as we are concerned, Finance Bill 2023 does not apply to us. I am mentioning it only for clarificatory purpose. What we need to know is that Bombay High Court decision of Santojan Silk Mills. Suppose a question is asked in exam, although I doubt, suppose a question is asked in exam where they say that whether benefit or perquisite in cash should attract TDS under 194R. You should write as per CBDT circular. CBDT has clarified that 194R shall apply whether the benefit or perquisite in the course of business or profession is in cash or kind. In either case, TDS will be attracted. However, Bombay High Court, in the context of section 28 clause 4, held in the case of Santojan Silk Mills that the wording benefit or perquisite whether convertible into money or not indicates that the benefit or perquisite has to be non-monetary in nature. Applying the same rationale due to similar wordings used in 194R, one can argue that section 194R as it stands as per Finance Act 22 applies only on non-monetary benefits. I hope this is clear. Next is there any requirement to deduct tax under 194R when the benefit or perquisite is in the form of capital asset? Yes, there is no restriction. Once we know that it's a benefit or perquisite arising in the course of business or profession, tax is deductible. They have given some examples, you all can go through that. Then they say whether sales discount, cash discount and rebates are benefit or perquisite. Now over here this is a tricky question, because as far as discount is concerned, that is first of all factored in your sale price itself. So whether that discount can be considered as a benefit, CBDT says sales discount, cash discount, rebates allowed to customer from listed retail price represent lesser realization of sale price itself. To that extent, purchase price of customer is also reduced. These are also benefits though related to sale or purchase. Since section 194R is applicable on all forms of benefit or perquisite, tax is required to be deducted. However, subjecting these to tax deduction would put the seller to difficulty. To remove such difficulty, it has been clarified that no tax is required to be deducted under 194R on sale discount, cash discount and rebate allowed to the customer. So, is it a benefit or perquisite? Yes, but then on each and every discount allowed, if the seller starts deducting TDS, because he is not providing, he is not paying anything, so how will he deduct? So, it is as good as, let us say I sell you goods worth 100 rupees. Now, you tell me that I will give you cash today, money today, provided you give me 10% discount. So, I tell you, okay, 100 rupees you are required to pay me, you pay me 90 rupees. Now, that 10 rupees is technically a benefit. Now, on that benefit, if I am required to deduct TDS, how will I deduct? I am not giving you any amount. I am realizing a lower value from you. So, I will have to ask you only that boss, that 10 rupees is a benefit. I am required to deduct TDS. So, please give me 1 rupee extra, which I will deposit to the government. The customer may think this is ridiculous. So, government said that in such cases on discount there is no requirement to deduct TDS. Fair enough. After that, how is the valuation of benefit or perquisite required to be carried out? Suppose the person who is providing the benefit has purchased the benefit or perquisite, like that watch given to the doctor. The patient went to the market, purchased the watch. So, whatever is the purchase price, that would be regarded as the value of benefit. And suppose I have manufactured that item which I am giving to someone as a benefit or perquisite, then the price that it charges to its customers for such items shall be the value of benefit or perquisite. GST will not be included for the purpose of valuation. Next is social media influencer. I will read the question. It says, many a times a social media influencer is given a product of a manufacturing company so that he can use that product and make audio video to speak about that product in social media. Is this product given to such influencer a benefit or perquisite? You may have seen this on social media. Earlier days when we used to watch TV, at that time advertisements used to come on television box, many of which were irrelevant to me. Like for example, I am a kid and some shaving cream ka ad comes. Now that's irrelevant to me. So I used to just ignore it or change the channel. But now companies have realized that the advertisement has to hit the target customer. It has to be on the point, and as a result, this social media influencer business, it has sort of taken off. What do you mean by social media influencer? Although I am very sure you know more than me, but let me clarify for those few % people who may not be aware. Social media influencer means a person who has got good amount of following on social media. Like for example, all girls may be following one actress on social media, on Instagram or maybe on Facebook, that is, let's say Aishwarya Rai. All boys may be following Shah Rukh Khan. Even the companies know that. So suppose tomorrow Lakme wants to launch a new line of lipsticks. Which will be a better bet to reach the target audience? Shah Rukh Khan or Aishwarya Rai? Naturally Aishwarya Rai, because they know that Aishwarya Rai will have more number of followers who are going to use lipstick. Or maybe now Aishwarya Rai, I think may not be relevant example, the new actresses, Anushka Sharma, let us say. So most of the people, most girls would be following that particular person. So social media influencer, in order to promote, in order to advertise a product, may be given with a sample of that product. It so happens na that you see, okay, Shah Rukh Khan on maybe Twitter or some page, he will say, I purchased this watch and fantastic watch, it's really nice, how much does it cost? 2 lakh rupees. So many people watch that and they say, oh, even I need this watch. So social media influencers are provided with the product of a company so that they can use the product, and usage of that product itself acts as an advertisement. So whether that is a benefit or perquisite, here they say, in case the benefit or perquisite being a product like a car, mobile, outfit, cosmetic, etc., and if the product is returned to the company after using for the purpose of rendering the service. So Shah Rukh Khan puts it up for 2 minutes and then he gives it back to that company saying that le lo bhai, itna mehenga watch, it's not affordable. In that case, there is no perquisite or benefit because they were just acting with that product. But in case they retain it, then in that case it will be regarded as benefit or perquisite and tax would be required to be deducted at source. I hope this is clear. Next, whether reimbursement of out-of-pocket expense incurred by a service provider in the course of rendering the service is a benefit or perquisite. Now, they have interestingly clarified that any expenditure which is liability of a person carrying on business or profession, if made by the other person, is in effect benefit or perquisite provided by the second person to the first person in the course of business or profession. So, the example itself is clarificatory. A consultant is rendering service to a person X for which he is receiving consultancy fee. In the course of rendering that service, he has to travel to different city from the place where he is regularly carrying on business or profession. For this purpose, he pays boarding and lodging expense incurred exclusively for the purpose of rendering the service to X. Ordinarily, the expenditure incurred by the consultant is part of his business expenditure which is deductible from fee that he receives from company X. In such case, the fee received by the consultant is his income and expenditure incurred on travel is his expenditure. So let us say I am going to charge you 100 rupees. Now because I had to incur some expense for rendering my service, let's say 10 rupees. So I ended up charging you 110 and that 10 rupees was debited to my P&L. Now instead of doing that, I ask you only that you incur that 10 rupees on my behalf. So that is naturally a benefit or perquisite to me on which tax is required to be deducted. So if this travel expenditure is made by company X, it is benefit or perquisite provided by X to the consultant. In such case, tax is required to be deducted under 194R. Fair enough. And they have also clarified if on out-of-pocket expense already TDS has been deducted under 194J, then there is no further requirement to deduct tax under 194R. Next is, if there is a dealer conference to educate the dealers about the products of the company, is it a benefit or perquisite? Now, it depends, because if there is a genuine conference, let us say for new products being launched, or maybe discussion as to how the product is better than others, how to market it to the consumers, there may be various such conferences. Now, those conferences may not be regarded as incentives or benefits. However, this conference should not be only for particular select dealers. Suppose you are giving it only to select dealers who have achieved some target, then that may be in the nature of benefit or perquisite. Further it says, if there is a dealer conference to educate the dealers about the products of the company, is there a requirement that all dealers must be invited to the conference? How to identify the benefit against the individual dealers in a group activity? So, they are digging deep into it. As I told you that if it's a general conference for all dealers of the company, and that is for launching of a new product, or maybe to educate the dealers with regard to a product or as to how to market them, then that is not a benefit or perquisite arising to any person. But only a select group of dealers are invited, those who have achieved a particular target, then that may be indicative of the fact that there is some benefit or perquisite involved. Ancillary factors may also have to be seen. Like for example, if the conference is outside town, then who is bearing the expenses for travel up to that conference room? Who is paying for the accommodation of those dealers? All those may be indicative of whether any benefit or perquisite is embedded or not. But now they are asking that how do you understand that even if suppose specific dealers are invited for a conference, but in that group activity, what is the individual value of benefit given to each dealer? How do you identify that? So for that purpose, CBDT says that it is not necessary that all dealers are required to be invited in a dealer or business conference for the expense not to be considered as benefit or perquisite under 194R. There may be expenses during such dealer or business conference which need to be classified as benefit or perquisite, and tax is required to be deducted under 194R. However, there may be practical difficulties in identifying such benefit or perquisite to the actual recipient due to the fact that it is a group activity and reasonable allocation is not possible. Non-compliance of provision of 194R in such case would not only result in disallowance under 40IA but may also result in treating the benefit or perquisite provider as the assessee in default under 201. In order to remove these practical difficulties, it has been clarified that if benefit or perquisite is provided in a group activity in a manner that it is difficult to match such benefit or perquisite to each participant using a reasonable allocation key, the benefit or perquisite may at his option, a provider may at his option not claim the expense representing such benefit or perquisite as deductible expense for calculating his total income. If he decides to opt so, he will not be considered to deduct TDS under 194R on such benefit or perquisite and therefore will not be treated as assessee in default. Thus, in such case, he must add back the expenditure representing such benefit or perquisite to calculate his total income if the expenditure is debited in the account. So in short, the government is saying that if you are providing a conference to dealers, there may be some benefit or perquisite like hotel stay kharcha, traveling expense, food expense, or maybe sightseeing. You have taken them for conference, but then one day sightseeing is there. Now that is a group of dealers. It is not possible to identify out of that for every person how much is the value of benefit. This fellow ate 2 chapatis, that fellow ate 3 chapatis. You can't identify like that. So then they say, okay, if you are not able to identify on any reasonable allocation key, then you please disallow that total benefit of perquisite expense. You disallow it in your computation of income, then you will not be regarded as assessee in default. Fair enough. Next question, section 194R provides that if benefit or perquisite is in kind or partly in kind and cash is not sufficient to meet the TDS, then the person responsible for providing such benefit or perquisite is required to ensure that tax is required to be deducted has been paid in respect of benefit or perquisite. Before releasing the benefit or perquisite, how can such person be satisfied that the tax has been deposited? So this is where the benefit or perquisite is in kind. It says the requirement of law is that if a person is providing benefit in kind to a recipient and the tax is required to be deducted under 194R, the person is required to ensure that tax required to be deducted has been paid by the recipient. Such recipient would pay tax in the form of advance tax. The tax deductor may rely on a declaration along with copy of advance tax payment challan provided by the recipient confirming that tax required to be deducted on the benefit or perquisite is deposited. This would then be reported in the TDS return along with challan number. This year, Form 26Q has included provisions for reporting such transaction. In the alternative, as an option to remove difficulty, the benefit provider may deduct tax under 194R and pay it to the government. The tax should be deducted after taking into account the fact that tax paid by him is also a benefit under 194R. So you gross it up. Basically, they are saying you gross it up. So I am giving you a watch worth 1 lakh rupees. It is a benefit of perquisite. Either I ask you that please give me 10,000 rupees, that is you pay it as advance tax, or I gross it up. So I will say the value of benefit is 1,11,111, on which 10% TDS is 11,111, and the net balance 1 lakh is given to you in the form of a watch. That is what you can do. One more interesting scenario, in fact, I would say you can star mark this portion. Now the scenario that they are talking about is that suppose a company gifts a car to the dealer. Now that entire value of car is a benefit for the dealer. How they deduct TDS is immaterial. The company may either bear it or they may recover it from the dealer, that is all fine. But for the dealer, the entire value of car becomes a perquisite or a benefit on which he has to pay tax. Under 28 clause 4, it will be regarded as PGBP income. Now suppose that car is used for business or profession. Then what will be the actual cost on which depreciation is allowed? So for that, they are saying it has been clarified, white circular, that once company A has deducted tax on gifting of car in accordance with 194R, or release the car after dealer B has showed him the payment of such tax on benefit, and dealer B has included the value of this benefit as income in his income tax return, it would be deemed actual cost of the car for the purpose of section 32. Hence the dealer B can get depreciation on fulfillment of other conditions for claiming depreciation. That is, it should be put to use, it should be used for business, etc. So the point is that this value of benefit, because you are paying tax on the entire value of benefit, then you can add that amount to your actual cost and claim depreciation thereon. Interesting clarification. Next one, 194R would come into effect from 1st July 2022. It provides that the provision of this section does not apply where the value or aggregate value of benefit or perquisite provided or likely to be provided to a resident during the financial year does not exceed 20,000. It is not clear as to how this limit of 20,000 is computed for FY 22-23. See, because the provision comes into force from 1st July. So this 20,000 limit, how that should be considered? That should be considered for the entire financial year. So let us say prior to 1st July 22, you have already given some benefit to a person exceeding 20,000 rupees. So that limit of 20,000 is exhausted. Now from 1st July, even 1 rupee benefit you provide, on that TDS is deducted. Suppose prior to 1st July, you have given benefit of 10,000 rupees. And after 1st July, you are giving benefit of 25,000 rupees. Then you will say total is how much? 35, out of which 20,000 is the limit that has been crossed. So on the benefit value after 1st July, you will be required to deduct TDS. If any benefit is given prior to 1st July, there is no requirement to deduct TDS. But for considering the threshold of 20,000, the value of benefit right from 1st April shall be considered. Fair enough. Whether embassies, high commissions are required to deduct tax under 194R? No, because they are granted immunity under United Nations privileges. Whether issuance of bonus share or right share is a benefit or perquisite? Not at all. Because in case of bonus shares, the intrinsic value of the company remains the same. Bonus is nothing but a capitalization of reserves. So overall for the shareholders, their intrinsic value, their net worth remains the same. So there is no benefit or perquisite, therefore there is no requirement to deduct tax. That was, friends, as far as section 194R is concerned, very important from examination perspective. Let us proceed on to the next one. As far as 2011A is concerned, we know that under section 201 subsection 1A, if tax has not been deducted at source, then interest applies on the unpaid TDS at the rate of 1% per month if tax has not been deducted. But suppose tax has been deducted and not deposited, then 1.5% interest applies. There is a technical amendment this year which only says that once the interest is charged in the order by the assessing officer, interest shall be paid by the person in accordance with that order. So in short, as per the provision, you are required to pay the interest. Once as per the provision the AO computes the interest and puts it in his order, that becomes the demand payable for you. That is fine. Fair enough. Section 206AB, we have already covered this in detail. 206C subsection 1G, this is important. I expect a question on this. It's a good amendment. 206C subsection 1G, we are aware, talks about any remittance outside India or any amount spent on overseas tour program package. Government says if you are spending on either of these events, then the authorized dealer or the tour operator shall collect TCS at the rate of 5% on the amount exceeding 7 lakh rupees. However, if it is for tour operation purposes, then in that case, the limit of 7 lakhs also does not apply on the entire value. The amendment this year is with regard to a person who is a non-resident and has come to India. He does not have any permanent establishment in India. So let us say my cousin brother stays in Australia. He comes to India. Now in order to surprise me, he has booked a tour package for Bhutan or Nepal. Technically now that is for travel outside India. So the authorized dealer will collect TCS from him, but that person does not file a return in India. That TCS can never be claimed by him as a credit. So unnecessarily it creates a burden on the non-resident assessee. As a result, government has clarified that central government wide so and so has clarified that section 206C subsection 1G will not be applicable to a person who is a non-resident in terms of section 6 and does not have a permanent establishment in India. So if a non-resident is remitting any amount or a non-resident is booking overseas tour program package, the authorized dealer or tour operator will not collect any TCS. I hope this is clear. 206C1H we have already covered. Next important amendment is section 239A. Very good amendment. It was it should have been done long back by the government, but better late than never. See, let me explain what is this amendment about. Whenever a person is making remittance outside India, let us say there is some intellectual property owned by a non-resident and I am making a payment for using that intellectual property to the non-resident. The amount is, let's say, 10 lakh rupees. As per the provisions of Income Tax Act, that 10 lakh rupees is chargeable to tax in India at 10%. But we very well know that whenever there is a double taxation avoidance agreement, the provisions of the Act or DTAA, whichever is more beneficial, shall apply to the assessee. Now the non-resident owner of intellectual property, he says that as per the DTAA there is no requirement to deduct tax on this payment because this amount does not fall within the meaning of royalty, and because I do not have a permanent establishment in India, the business income is not liable to tax. But my chartered accountant tells me that the interpretation is a bit risky, it may entail litigation, and tomorrow it may result in disallowance of the expense of 10 lakhs. Now I am in a dilemma. What should I do? Should I deduct TDS or not deduct TDS? Because as per the act it is deductible. Naturally DTAA provisions, to the extent it is more beneficial, shall apply, but that is also confusing. It's not clear cut, clear shot that tax is not deductible as per the tax treaty. So I tell the non-resident that, sir, if you may please allow me, I will deduct TDS, you file a return in India and claim refund, because according to you this income is not chargeable to tax. The non-resident says, get lost. You want my business, you want my intellectual property. If you want me, then listen to me. I want 10 lakh rupees net. आप TDS deduct करो, कुछ भी करो. I want 10 lakhs. Now again I am in a dilemma. So what I do is, I gross up the payment under section 195 capital A. I gross up the payment and net of tax I release 10 lakhs to the non-resident, because I want his intellectual property. He is a sine qua non for me, essential requirement for my business. So I release 10 lakhs to him. That TDS which I bore, I deposit to the government, because I don't want to take a risk. Tomorrow if I don't deduct TDS on that risky interpretation and the assessing officer catches me red-handed, then interest, penalty, expense will be disallowed, prosecution, all those nonsense things can happen to me. So I pay the TDS out of my own pocket. Once I bear the amount of TDS, once I, payer, bears the amount of TDS, I had a right up till last year to directly file an appeal under section 248 with the Commissioner of Income Tax Appeal, immediately after depositing the tax. And the argument would be that, sir, although I have deposited the tax to be on a safe side, out of precaution, out of abundant caution, but I feel tax was not deductible because of that DTAA provision. So now please pass an order saying that this amount should be refunded to me. Some students may be having a doubt. Sir, if you are filing an appeal that tax was not deductible, then why did you pay it in the first place? Please understand, friends, I paid it in the first place out of abundant precaution. Tomorrow what if the argument had gone against me? Then the income tax department would disallow 100% of the expense under 40AI, would recover the TDS under section 201, would recover the interest on TDS under 201(1)(a), would start prosecution provisions against me. Rather than that, it is better to deposit the tax and then claim a refund. It is as good as, it's a monsoon season, let's say it's monsoon. You see clear sky in the morning. Now what is better, not to carry an umbrella or carry an umbrella? Now suppose you don't carry an umbrella and it starts raining, then you are doomed. You will have to wait under some shade till the time the rain is there. Rather than that, I would prefer to carry an umbrella. Even if it does not rain, it's okay, mere bag mein that umbrella will be there. I will come back home safely. Even if it rains, I am protected. Similarly, friends, whenever you are not clear, you are not sure, better to deposit the TDS. Once you deposit the TDS, suppose tomorrow you file appeal, Commissioner appeal says, no sir, you are required to deduct TDS. Koi baat nahi. I have already deducted TDS, deposited to the government. So I am safe. Nothing can be done against me. But suppose the Commissioner appeal decides that tax was not deductible, I will get back the amount as refund. But what used to happen was, when you file an appeal with Commissioner appeals, unfortunately there is no time limit for Commissioner appeals to decide the appeal matters. My friends who have attended my appeal and revision lecture know where I am drifting, because post introduction of faceless assessment and appeal provisions, The faceless commissioner appeal is not deciding on matters, or I don't know, maybe some matters where I am involved, they are not deciding. But the matter, I mean, it has been lingering around for a long time. The reason is because commissioner appeal, there is no time limit to decide the matter. So, under section 248, although you file an appeal, it used to take a long time. Now the government has amended the provision by introducing 239A, where they say that if such a tax has been deducted under 195 to non-resident and borne by the payer, then you file an application with the assessing officer within 30 days claiming refund. The assessing officer shall pass an order in writing, either allowing or rejecting your application. And after the order is passed, then it will be appealable to Commissioner of Income Tax Appeal under section 246A. The order has to be passed by AO within 6 months. So there is a time limit. Unlike Commissioner Appeal, where they can sit on the file for 3 years, 4 years, here it will be decided within 6 months. Thank God for that. Anyway. Next one, a very small amendment in section 119. Section 119, as we know, that if the assessee has a genuine hardship, he can make an application to the CBDT to relax the provision of law to give him some benefit. In that list of sections for which CBDT can give benefit, section 234F has been included. 234F, if you remember, is the fee which is applicable if a person fails to furnish the return within time, then a fee of 5,000 applies. So in case you have not furnished the return within time due to some genuine hardship, you can now make an application to CBDT and CBDT can waive off the fee which is levied on you. Next amendment is in section 139(1). This is with regard to 7th proviso to section 139(1). Please remember, friends, who is required to furnish a return of income? If you are a company or a firm, then it is mandatory for you to furnish a return every year. No exceptions in that. Even if you claim the company has not done any operations, or company is in losses, or it does not have bank account, it does not have any activity during the year, doesn't matter, return has to be filed. It can be a nil return, but it has to be filed. Apart from a company or a firm, any other person is required to furnish return only if his or her income exceeds basic exemption limit. Now suppose there is a person who is not required to furnish return because his income does not exceed basic exemption limit. Still that person may be mandated to furnish return if he satisfies any one of the conditions given in 7th proviso to section 139(1). Now what are those conditions? We already know in 7th proviso they have given if a person deposits more than 1 crore rupees in current account maintained with a bank, or incurs expenditure exceeding 2 lakhs for travel to a foreign country, or incurs expenditure exceeding 1 lakh towards consumption of electricity. Now in that list they have added wide rule 12AB further conditions, that is, if any person whose turnover in business exceeds 60 lakhs, if there is any person whose gross receipt in profession exceeds 10 lakhs, or if there is a person whose aggregate of TDS plus TCS exceeds 25,000, or in case of senior citizens 50,000, or a person who has deposited in a savings account 50 lakh rupees or more during the year, then that person is required to furnish a return, notwithstanding the fact that his or her income does not exceed basic exemption limit. So let us say they ask you a question in exam that Mr. Raj has total income of 2 lakh rupees. Is he required to furnish return? No, because his income does not exceed basic exemption. When I say income, of course, after adding back all your deduction under chapter 6A, all that we have covered in our lectures. But then they say, will your answer change if he has deposited 52 lakhs in savings bank account during the year? Yes, answer will change, because now as per 7th proviso to section 139(1), read with rule 12AB, he would be mandated to furnish return. Section 170A is effect of order of NCLT in case of business reorganization. Please understand friends, with regard to business reorganization, the government has brought about two amendments. First and foremost, to explain the first amendment, let me tell you a Supreme Court decision, that was Maruti Suzuki. The assessing officer, although he was required to know, but many a times is unaware if a company has been amalgamated into another company, or some kind of demerger has taken place, or some kind of business restructuring has taken place. So, in Maruti Suzuki's case, the assessing officer initiated assessment proceedings on a company which had already amalgamated into another company. So, let us say there was X Limited had amalgamated already into Y Limited. So, now which is the entity in existence? Y. The proceeding should have been initiated on Y. AO was not aware. So, what the assessing officer did, he initiated the assessment proceedings on X. Supreme Court of India said, initiating assessment proceedings on a non-existing entity is void ab initio, and therefore the entire assessment was declared as null and void. Now, in order to make the assessing officer aware of such kind of business reorganizations, so that such mistakes do not occur, the government says now whenever there is a business reorganization within a period of 6 months from end of month in which the NCLT order is passed, the successor entity has to file a modified return in ITR A. The whole idea is that now the AO will be aware that such kind of business reorganization has taken place. That's the whole idea. Further friends, the government has inserted one more section, that is section 170AA. I think that is given a bit ahead, but let me explain that 170AA to you. As far as that provision is concerned, the government says that whenever there is a corporate insolvency resolution brought against a company by, let us say, the operational creditors, after the order, the adjudication process is done, and after the resolution is passed, all the existing liabilities, all the existing debts of the company are done away with, and the successor entity is given a lifeline to start afresh. Income tax department is one of the operational creditors. So, let us say there is X Limited, that X Limited has to pay 100 crore rupees income tax demand, which they have not. Now, income tax department has to mention that to the NCLT, because when the resolution will be conducted, at that point in time, income tax department's demand will also be met. But income tax department said, sir, I can mention to you only those demands where the assessment order is passed. What if only a reassessment proceeding has been initiated, but order is not yet passed? Then what do we do? So, over here, certain high courts gave a decision saying that even pending proceedings shall abate, shall come to an end once the resolution process is passed. In order to overrule those decisions, government has amended the law, and they have said if there is any action initiated on the predecessor, even though order may be passed under IBC, after that on the successor entity the proceeding shall continue. This amendment of course directly goes in, I would say, friction with the spirit of IBC and is about to be challenged. It will be challenged in courts of law. But as the provision stands today, if a proceeding is initiated on the predecessor, even after the resolution process, it will be deemed to be continued on the successor. That is as far as business reorganization is concerned. Moving ahead, The next amendment is with regard to section 139A. The government has inserted in the list of persons mandatorily required to apply for allotment of PAN. So suppose any person who wants to deposit cash in a bank or cooperative bank or a post office, aggregate during the year of 20 lakh rupees or more, then at least 7 days before the date on which he intends to deposit cash over the specified limit, that is when he is crossing the threshold of 20 lakhs, just 7 days prior to that he will have to apply for PAN if he does not have one. Or in case he wants to deposit in cash in one or more accounts, that is withdraw cash from one or more accounts in a bank, cooperative bank or post office aggregating to 20 lakh rupees or more, again 7 days prior to that he is required to apply for PAN. Or in case any person who intends to open a current account in a bank, at least 7 days prior to that he is required to obtain a PAN if he does not have one. Moving ahead, quoting and authentication of PAN or Aadhaar number. So over here, in case of PAN and Aadhaar number, we know that it is mandatory in some transactions to quote PAN or Aadhaar number. Again, they have extended that list. Same kind of transactions, if you are depositing cash of 20 lakh rupees or more, or withdrawing cash of 20 lakh rupees or more, or you are intending to open a current account, then quoting of either your Aadhaar number or PAN number shall be mandatory. Next is quoting of Aadhaar number, section 139AA. We know that prior to 31st March 2022, every assessee was required to link his Aadhaar number with his PAN number. If he did not do it up till 31st March 2022, then there is a fee of 500 rupees if he did the intimation, that is linking, before 30th June 2022 and 1000 rupees after 30th June 2022. Also friends, up till 31st March 2023, in case a person does not quote his Aadhaar number and does not link his Aadhaar number with PAN, then the PAN number shall become inoperative. Next is updated return of income. This concept we have covered in detail during our lectures. Just as a recap, I have told you that the revised return of income or a belated return of income can be furnished maximum up till 3 months prior to end of relevant assessment year. So if we talk about assessment year, let's say 22-23, the original return had to be furnished by 31st July 2022, that is EY 22-23. The original return had to be furnished, return within due date had to be furnished by 31st July 2022. If you have audit, then it would be 31st October. If you have transfer pricing, 30th November, be that as it may. Now suppose you want to revise this return, then the last date for revision of this return is 31st December 2022. Suppose you did not furnish the original return at all, then the last date for belated return is also the same, that is 31st December 22. Suppose this 31st December 22 has now gone. You want to file a return for AY 22-23. So what do you do? In such cases friends, you can furnish something called as a updated return of income. Updated return of income can be furnished maximum within 24 months from end of relevant assessment year. So if I talk about AY 22-23, then updated return can be furnished, end of relevant assessment year is 31st March 23 plus 24 months, so that is 31st March 25. Up till that time updated return can be furnished. However, because the government is doing a ehsan, they are doing a favor to you by allowing you to file a ITR-U, that is updated return. That's the reason why they say we will charge you some extra tax. Now what is extra tax? Additional tax as they call it under section 140B. The additional tax shall be 25% extra in case the updated return is furnished within 12 months from end of relevant assessment year. So additional 25% tax has to be paid. And in case the updated return is furnished after 12 months but within 24 months, then 50% of aggregate of tax interest is payable additionally over and above your normal tax liability. So clearly updated return is only for the benefit of income tax department. Over here the only thing is, if you have not disclosed any transactions, if you have not disclosed any income, rather than the assessing officer reopening your proceedings and later you may face consequences of interest, penalty and prosecution, you show it on your own, pay the additional tax, at least there would be no penalty and prosecution. Further friends, please remember, updated return cannot be furnished to reduce your total income as compared to what you have originally disclosed in the return under 139(1). It cannot be furnished to enhance your refund, and it cannot be furnished in case already proceedings are pending against you under Income Tax Act or in relation to the same transaction under some other law. Then you cannot furnish this updated return once you are caught. Several examples are given, you can go through that. We have already done this in class. Okay, next is faceless inquiry and valuation. That is, we know that under 142 capital A, the departmental valuation officer, a case may be referred to him regarding valuation. Further, under section 142(1), notices are issued before completion of assessment for collation of data. We now know that entire assessment process has become faceless. As a result, all these inquiries and references shall be done through a automated faceless manner. So the assessing officer will not know who is the departmental valuation officer while conducting inquiry. If another officer is conducting inquiry, the faceless AO will not know about it. The whole thing is done in order to bring transparency and reduce corruption in the system. Scrutiny assessment, we know since last year itself the time limit for service of notice under 143(2), that is the initiating notice for scrutiny assessment, is 3 months from end of relevant financial year. Section 144B, faceless assessment, we have covered in depth. If you remember that chart we have given regarding the procedure of faceless assessment. Over here, now the assessment will be conducted in a manner where the assessee does not know who is the assessing officer, the assessing officer will not know who is the assessee. The entire conversation, communication shall be done through an electronic system located at New Delhi called as National Faceless Assessment Center, or NFAC in short. Some people call it as NAFAC as well. So that, as far as assessee is concerned, the whole idea is that harassment and corruption will go down, it will bring more transparency in the system. We have already covered this. One small amendment this year which the government has brought about is that under section 144B, there used to be a subsection 9. Subsection 9 used to say that if the procedure given in faceless assessment, that is, the assessing officer has to give an opportunity of being heard. If a show cause notice is given, then first a draft assessment order has to be passed, shown to the assessee. Only after assessee replies, then the final assessment order has to be passed. Don't confuse this with the draft order under DRP chapter. This is show cause notice, which is called as draft order. In fact, Income Tax Department itself, in order to avoid this confusion, has now renamed that draft assessment order as ILDP. ILDP stands for Income Loss Determination Proposal. So the assessing officer has to give you a hearing via video conference facility, and that video conference facility is called as Divya Drushti. Divya Drushti. First time when I sat in front of that, I thought it's name of the officer, maybe two officers, Divya and Drushti. That's not there. Divya Drushti is the name of that video conference facility software. Now, if that procedure was not followed or there was some lapse in the system, section 144B subsection 9 said the entire assessment shall be declared as invalid. Now, many a times such kind of lapses were occurring. Assessee were filing writ petition against that, and high courts were quashing the entire assessment proceedings, declaring them as null and void. This was naturally against the interest of income tax department. As a result, the government has done away with subsection 9. That subsection 9 is omitted. So in short, now the procedure, even if it is not followed, still the entire assessment proceedings cannot be declared as null and void. That's the only amendment over here. Otherwise, rest of the things are same as we have covered earlier in detail. Moving ahead. As far as reassessment proceedings are concerned, Finance Act 2021 has overhauled the entire process of reassessment. Prior to 31st March 2021, the assessing officer could reopen an assessment only and only when he had a reason to believe that income chargeable to tax has escaped assessment. The reassessment could not be done on the basis of change of opinion or on the basis of maybe a fishing inquiry or surmises or conjectures. With effect from 1st April 2021, the assessing officer is not required to have a reason to believe. The assessing officer can conduct reassessment based on any information in his possession that income chargeable to tax has escaped assessment. Over here, one question arises that what is the time limit within which the reassessment proceedings can be initiated. The time limit for initiating the reassessment was reduced to 3 years from end of relevant assessment year. So, after 3 years from end of relevant assessment year, reassessment proceedings cannot be initiated. Just to give an example, AY 1920, the last day of the assessment year is 31st March 2020 plus 3 years. 31st March 2023 would be the last date when the reassessment proceedings for AY 1920 can be initiated. However, in case the assessing officer, based on possession of books of accounts or other documents or evidence, finds that income represented in the form of an asset escaping assessment is 50 lakh rupees or more. So, the income escaping assessment in the form of an asset is 50 lakh rupees or more, then reassessment could have been initiated up till 10 years from end of relevant assessment year. Now, the government also realized that suppose the income escaping assessment is in the form of an expenditure or maybe an entry in the books of accounts, then this provision will not be attracted because it required that income escaping assessment should be in the form of an asset. So, in order to benefit the income tax department, government has expanded the provision by saying now if income escaping assessment is 50 lakh rupees or more in the form of an asset or an expenditure in relation to a transaction or any entries in books of accounts, in that case the reopening can be done beyond a period of 3 years as well. So, reopening can be done for 10 years from end of relevant assessment year. So, for AY let us say 21-22, the reopening can be done up till 31st March 2032, provided the income escaping assessment is 50 lakh rupees or more. The next amendment pertains to appeal and revision chapter, that is insertion of a new section 158 AB. Welcome change from the income tax department, from the finance ministry, that is in order to avoid repetitive or consecutive appeals on the same issue. So, let us say there is a issue where assessee has claimed depreciation. According to income tax department, depreciation is not allowable on that particular asset, and against the assessee, income tax department has filed an appeal before the High Court or Supreme Court. Now, in the same case of same assessee for a subsequent year, because depreciation is a continuous allowance, every year you get it. So, the assessee has claimed it every year. So, unnecessarily for the next year, the year after that, the repetitive matters involving the same issue have travelled up to High Court. Or maybe there is some other assessee, our assessee was Mr. X, there is another assessee Mr. Y, in his case also the same issue is involved. In order to avoid now repetitive appeals, the government has inserted section 158 AB, which says that if an issue has travelled up to High Court, which is pending before High Court or Supreme Court, and in subsequent years for the same assessee, or maybe with regard to another assessee, identical issue is involved, which is covered by this matter which is pending in High Court or Supreme Court, then for that other assessee or for the subsequent years of the same assessee, Income Tax Department or the assessee will not file an appeal to High Court or Supreme Court, and they will just wait for the first issue to be decided, for the first year will be decided. But both the assessee and Income Tax Department have to agree that whatever is the decision given in the first year on the issue pending before High Court or Supreme Court, same rationale will be applied for the other years as well or for the other assessee as well. If both are in agreement with that, then in such case, in case of that assessee or in case of subsequent years, appeal shall not be filed to the High Court or Supreme Court. So that is as far as 158 AB is concerned. As I told you, in order to reduce litigation, this principle can be applied where a question of law is common and where decision of jurisdictional High Court on the same question of law is available. Okay. After this, the next amendment is in section 271 AAB, AAC and AAD. These are part of penalty provisions, and the assessing officer had the power to levy these penalties. With effect from 1st April 22, the power has been granted to Commissioner Appeal as well. So either the assessing officer or Commissioner Appeal can impose these penalties. Further, under section 272 capital A subsection 2, the penalty which was 100 rupees per day has been enhanced to 500 rupees per day. As you know, 272A subsection 2 provides a list of various defaults. For each default, 100 rupees per day was the penalty imposed. Now it will be 500 rupees per day. The next amendment is from a chapter pertaining to international tax, that is application and interpretation of tax treaties. Now this is clarification with regard to most favored nation. Now please understand friends, if you have forgotten regarding most favored nation, let me remind you all. Most favored nation clause appears in the protocol to any DTAA. Most favored nation, if I have to talk in common language, I will call them as best friend. So in the DTAA, if it is given that a particular country is my best friend, then I have to make sure that the most beneficial provisions are applicable to my best friend. I hope you agree. To give a practical example, India-France DTAA says that France is our most favored nation. Now once France is my most favored nation, let us say in the DTAA of India and France, the fees for technical service is taxable at the rate of 12%. Let's say, example. There is a subsequent DTAA with another country where the rate of tax provided on this same income, fees for technical service, is 7%. Now naturally, who will be upset? My best friend will be upset. So most favored nation clause means that if there is a provision in the DTAA and subsequently you have entered into any other DTAA and that other DTAA provides more beneficial provisions, then such more beneficial provisions shall be deemed to be incorporated in the DTAA of your most favored nation. So although India-France DTAA provides for rate of tax on FTS at 12%, but a subsequent DTAA provides for more concessional tax rate. So because France is my most favored nation, that more concessional tax rate shall be deemed to be incorporated in my India-France DTAA. But over here friends, many a times people have misused this most favored nation clause in interpretation. I am not talking at government level. When assessee interprets the DTAA, the government found that people are misusing this because there are some DTAAs with some East European nations, small nations, where maybe due to peculiar circumstances, certain extended benefits are granted. And assessee started arguing that because my DTAA is covered under most favored nation clause, the subsequent DTAA with that country should be made applicable to me because that is providing more concessional tax treatment. In order to avoid such kind of interpretation, the government has released a circular and they have said that most favored nation clause shall get attracted only when all the following conditions are met. First, the second treaty with the third country, that is after most favored nation treaty is entered into, thereafter you are having a subsequent treaty. In our example, the first treaty is between India and France. Let us say the second treaty is between India and Singapore, let's say. So they are saying that second treaty between India and Singapore is entered into after signature or entry into force of the treaty between India and the first state. So that is condition which was there right from beginning, that there is a subsequent treaty. You cannot have a retrospective application of most favored nation clause. When I entered into a treaty with France, I provide for a certain rate of tax, subsequently there is another treaty. Then the second treaty is entered into between India and a state which is member of OECD at the time of signing the treaty. So that subsequent state should be a member of OECD, only then most favored nation clause will apply. If that is the subsequent treaty is entered into with a country which is not an OECD member at the time of signing the treaty, then in that case most favored nation clause will not apply on the first treaty as well. India limits its taxing rights in the second treaty in relation to rate or scope of taxation for relevant item of income. So the second treaty is providing for a more concessional tax treatment. A separate notification has been issued by India importing the benefits of second treaty into the treaty with first state as required in section 90 of Income Tax Act. So this I would say is the most important condition. Now the government is saying that most favored nation clause will not trigger automatically. You have a treaty with India and France. France is my best friend. There is a subsequent treaty with Singapore. Singapore has got more concessional tax treatment. Still, automatically most favored nation clause will not be triggered. After that subsequent treaty is entered into, the government must give us notification saying that this treaty will now invoke the most favored nation clause with France. Only then, while interpreting this first treaty, I can say that the concessional rate of the second treaty will apply to me. I am very sure this fourth condition is going to be challenged in court of law, because what assessees will argue is that once you enter MFN clause in the treaty, there should be an automatic trigger with regard to MFN clause for subsequent treaties. You cannot have a condition that only when the government issues notification then the MFN clause can be invoked. But anyway, these four conditions are important from examination perspective. Right now it is not challenged, so we have to remember this. In fact, November 2022 RTP, we have that video on YouTube. The very last question is based on this. You can refer that video as well. That's it, friends. Those were the important amendments pertaining to May 23 and November 23 examination. I hope this lecture was clear to all of you. I wish you all the best. Thank you and take care.